Yes, perfect. Now the prospective information. Yes, perfect. So let's begin PFI, prospective financial information and other assurance engagement. In this, we all know that there are three standards. One is 3400, 3402, 3420. 3400 talks about prospective financial information examination of that. 3402 talks about control set service organization on that assurance report we are providing. 3420 talks about report on compilation of Pro-Forma financial information which is included in prospectus. Most importantly, the headings has to be very careful when you're writing the headings. Sometimes in MCQ heading may be tested, we don't know. A heading itself could have been tested. For example, 3420 you see heading is what? Assurance engagement to report on compilation of Pro-Forma information, financial information which is included in prospectus. And if you see, by the way, right now first I'm going to discuss two exceptional questions for there. So before that, I just want to give one small clarification on this. Now, 3402 where you are giving an assurance report on controls at service organization, 3420 where you are giving an issue where it's an assurance engagement to report on compilation of Pro-Forma financial information to be included in prospectus. Both these are reasonable assurance engagements, whereas prospective financial information is a moderate assurance, because PFI is generally future oriented other than historical. You know very well, right? 3000 series talks about assurance engagements other than historical. Therefore, this is not historical information, therefore moderate. Whereas this is on controls which is already implemented. This is on Pro-Forma adjustments. Here in 3420, something that we are talking about is nothing but Pro-Forma adjustments, unadjusted financial information, nothing but historical data only. In both the cases, the data used is historical. See, here it is non-financial information, here it is financial only, but it's a different side. So that's why we are giving added questions in ICA book. Only two questions were there, exceptional questions. Why I called it as exceptional, you see, those of you who have not read this question, if at all you are seeing this for the first time in the exam, you will forget to write this last point. This point many won't understand what exactly the question is talking about. There is an auditor approached by one company to examine prospective financial information. Okay, what factors an auditor considered before accepting? This is straight question. Technically, what are the factors while accepting the engagement? What factors you consider? Remember, this kind of questioning is there in 800 series, 2000 series, 3000 series, and even in 4000 series. In all these standards, questioning format, this kind, factors that the auditor has to consider, factors that the practitioner has to consider before accepting an engagement. This kind of questioning is there in every kind of standard. Now, under what conditions the auditor should decline? You see the part, you see how fantastic the question, three parts. What factors auditor should consider, under what conditions the auditor should decline or withdraw from the engagement, additionally what steps. Means there are three questions asked in this. How the weightage will be distributed? This will have some 3 marks weightage, this will have some 1 mark weightage, or this will have 1 mark, or factors question will have 2 marks, 1.5 mark for that, 1.5 mark for this. Like many students, what they do, they only write factors and come back. They forget to answer the second part of the question and third part of the question. Under what circumstances, what factors? Very simple. What is the use of the prospective? Why this PFI is prepared? Is it there for general distribution or is it for limited distribution? What assumptions are used? Are they best estimate or hypothetical? What are the elements included in the prospective information? For what period it was covered? These are the factors basically we cover before we examine prospective. This answer everybody will write. I hope you have revised it already. You will write. Wait, after finishing this question, I'll come back to the revision part and then I will revise that point. Okay, then under what circumstances you should not accept? That's the second part of the question. The auditor should not accept when assumptions are clearly unrealistic, or when the auditor believes that PFI will be inappropriate. The PFI, the intended purpose for which it is prepared, is not correct, or assumptions are clearly unrealistic, then you should not accept. Yes or no? Then third one, what additional steps should be taken to formalize the terms of engagement? What we need to do additionally to formalize the terms of engagement? To formalize terms of engagement, what we will do? We will issue engagement letter, agree on terms with the client by sending engagement letter, like just like any other engagement. Even in audit, in review, we give engagement letter, right? Just like that, give an engagement letter. That is the step that we take to formalize the terms agreed. See how fantastic the question has been asked. Now, question number 8. Here, what they are asking, 3400 talks about prospective information which can be a forecast or projection. Correct. In this context, how do you differentiate forecast from projection? So how forecast is different from projection? Also provide an example. Forecast means PFI. It's a prospective information which is based on assumptions as to future events which management is expecting that will happen, and the actions which management expected to take place, yes or no, that reflect anticipated experience with no provision of risk. Where the sentence is there, anticipated experience, assumptions that reflect experience of the management with no provision of adverse risk. So when they say no provision for adverse risk, that's actually called as best estimate assumption. Forecast is based on best estimate assumption. Example, in the present market condition, supply availability, the CFO, the chief financial officer, is expecting sales will increase by 5% for the next quarter. See how short run it is, very next quarter I'm talking about. Therefore 5% increase in sales in the next quarter, that next quarter, very short duration, that's a forecast. Projection means what? Projection is also PFI, which is based on hypothetical assumption. You see here they did not use the word hypothetical assumption in forecast. Here assumption is which kind of assumption? Best estimate assumption. Whereas in a projection, the definition itself clearly includes the word hypothetical. Hypothetical means what? It may happen or it may not happen. Adverse possibility is high. Whereas in a best estimate, no provision for risk of adverse deviation. Adverse deviation risk is generally very, very, very low. Whereas in a projection, in a adverse deviation possibility is extreme high. Then, and that's it, which are not necessarily expected to take place, such as some entities are in startup phase, all that. Getting it? Generally when we are preparing PFI, we may use a mix of best estimate assumption and hypothetical assumption. Either we use a best estimate or hypothetical or a combination whenever we are preparing PFI. So again, for projection they gave some example. Okay, in projection, no, hypothetical assumptions will be there. Whenever hypothetical assumptions are there, sensitivity analysis has to be shown in the PFI. Whether sensitivity analysis is shown or not, as a assurance provider, we have to look into. Therefore prospective information is relating to events that have not occurred or might not occur. Assumptions, it is purely based on assumptions, which is generally future oriented, speculative in nature. Therefore whether the results are shown in PFI, whether they will be achieved or not, can I give an opinion as such? I can't express any opinion. That is why the assurance that we give on prospective financial information is only a moderate level of assurance. That's it. If you understand these two questions, you are more than enough. Like this is more than enough. Next, now coming to, let's discuss PFI, and then all that. Only important points I'll cover, which is exactly important from exam point of view. I will discuss this now. So what is this? 3400 examination of prospective financial information. In this, what exactly important is, you see, forecast. Forecast means prospective information based on assumptions. You see, they did not use which type of assumption, they simply use the word assumption. Whereas projection, if you see, PFI is based on hypothetical assumptions. Assumptions are different from hypothetical assumptions. Here assumptions means what? Assumptions are the one which reflect experience, anticipated experience with no provision for risk of adverse deviation. That's what I showed in the exceptional question. Yes or no? Generally a mix of best estimate and hypothetical assumptions are used to prepare PFI. Now here, even in assurance engagement 3400, the word auditor is used. That doesn't mean historical statutory auditor. Here the auditor who is giving report on assurance engagement, the auditor who is giving report on PFI, he can be a different auditor, not necessarily a statutory auditor. Then, by the way, this standard does not apply where you are examining PFI, which is expressed in general terms in annual reports. If you see any annual report, no, management discussion and analysis, company future outlook related information and all will be there. Even in under SS 720, we need to read other information. Other information means what? Other information included in annual report. And even in 720 standard, they say we are reading other information not to give opinion thereon. We are reading other information to find inconsistency between other information and financial statements. So that's it. So just because we are reading something, prospective financial information, some PFI we are reading, some PFI we are examining, that doesn't mean 3400. 3400, when it apply, when you are specifically appointed to report on PFI, your duty is to give a report on PFI, then only 3400 will apply. Then What is the nature of assurance provided? This itself straight away 3 marks question possible in exam. So PFI relates to future events which are not occurred, may not occur. Evidence used is generally future oriented, therefore speculative in nature. It is different from evidence which is there in historical data, therefore the level of assurance is very moderate. That's what I told at the beginning. The level of assurance in prospective financial information examination is moderate level of assurance, whereas in controls on service organization, which is called as SOC audit, type 1 type 2 report we will give, whereas in 3420 Pro-Forma information, yes or no, there in both the cases the level of assurance that we give is reasonable assurance. Next, so an opinion cannot be expressed whether the prospective information results shown in the prospective financial information will be achieved or not. So next, now can a CA in practice deal with prospective financial information? Absolutely yes, no problem. However, there is a clause. Which clause? Clause number 3, part number 1 of second schedule of CA Act. What it says, it does not allow CA in practice to associate with reports where earnings estimates and all will be there. It is prohibiting. However, if you are disclosing the source of information clearly, you are explaining the basis for forecast and state that you did not vouch accuracy. If you mention clearly these 3 points in the report that you are giving, then you are not treated as guilty of professional misconduct. Further, the same rule applies to projections based on hypothetical assumptions, where you clearly have to mention that you do not vouch the accuracy. Therefore, what is the duty of the member who is examining PFI? What is the duty of the members examining prospective financial information? What exactly the duty of the chartered accountant to examine? Who is examining? First, verify best estimate assumptions are reasonable. Hypothetical assumptions, they are consistent with purpose of the information. Why are you preparing prospective financial information? Okay, for that, what assumptions I can take? Whether the assumptions are matching with that purpose or not. Whether the assumptions are reasonable. Assumptions must be reasonable. Assumptions must be matching the purpose for which the PFI is prepared. And ensure that PFI is properly prepared. See that the information is prepared based on these assumptions correctly. First, assumptions reasonable or not, check out. 2, whether these assumptions and the purpose are they aligning with each other or not. 3, whether the PFI is prepared based on this assumption, check out. Then see that the PFI is properly presented. Prospective information, the financial statements are there at prospective, whether they are clearly disclosing all the assumptions, material assumptions, best estimate assumption, hypothetical assumptions, are they clearly disclosing the assumptions or not, you should check. Most importantly, consistency. What is consistency here? Sir, PFI, suppose no, sir, historical financial statements, balance sheet, P&L, what is the format applicable for that? Schedule 3, part 1, part 2, schedule 3, part 1, part 2, part 3, depending upon the accounting standard applicable, depending upon the type of the entity, part 1, part 2, part 3, schedule 3 is applicable. This now PFI should also be prepared using the same format. The framework should be same. So the auditor should verify that PFI is prepared on a consistent basis with historical financial statements using appropriate accounting principles. In past, I'm using WDV method for depreciating machinery. Even in PFI, the method of depreciation should be WDV. Inventory valuation is FIFO. Even in PFI, inventory valuation should be FIFO. So the accounting policies that we follow, financial reporting framework that we follow should be consistent with historical financial information. And remember, all other auditing standards, whenever you are examining PFI, whatever exam, suppose you want to get external confirmation, you can get it. For that, 505 standard you can use happily, no problem at all. That's it. So these are the duties of the member who is examining prospective financial information. Easy or not? So what are the duties of the member examining PFI? Assumptions you need to verify. Whether they are prepared based on the assumptions or not, you need to check. Whether assumptions are clearly disclosed on, you need to check. Whether the PFI is prepared on a consistent basis with historical financial information or not, you can use other standards wherever relevant. Then acceptance of an engagement. This is very important. That's what just now we saw in exceptional questions. What are the points the auditor should consider before accepting examination of PFI? What is the purpose? To whom it is distributed, limited or general? Whether best estimate assumptions used, hypothetical assumptions used, what information is included in PFI, what is the period for which they are covering, when to decline or withdraw. The auditor should reject or withdraw if assumptions are clearly unrealistic. Auditor must agree on terms with client through engagement letter. This is a formalized process, yes or no? And when you are reporting on PFI, the auditor should assess whether past financial data is reliable. First of all, if at all past financial statements are not reliable, and if any PFI is prepared based on the past data which is not at all reliable, generally we will not accept that PFI. Simple. So what are the points a practitioner shall consider before accepting an engagement? That's it, answer over. Then how should we conduct examination, how should we verify, what we should verify. Very simple. What you should verify, key factors in examination. Here actually it is talking about factors. Okay, so when deciding nature, timing, extent of process, so when you are planning the audit, when deciding nature, timing, extent means what? Planning examination of PFI, when you are verifying, when you are examining PFI, when you are planning this examination, you need to plan the work, right? So when you're planning, you should consider what is the knowledge that you have in the previous engagements. Management is competent or not. What is the likelihood of MMS? Nothing but risk assessment you do. Extent to which affected by judgment. What is the level of assumptions and judgments? Sources of information. PFI is prepared based on some underlying in data, right? Some data from where the data has been gathered. Suitability. Engagement team experience with the business. So not only all that, our team experience, our team ability, that also we should check. Then evaluate source and reliability of the data, such as budgets and all. If hypothetical assumptions are used, significant implications must also be considered. Ensure hypothetical assumptions align with financial purpose and not unrealistic. The hypothetical assumptions must match with the financial purpose, nothing but the purpose for which PFI is prepared. And finally, presentation and disclosure of PFI. This itself can be asked as a 4 marks question directly. Remember, examination procedures, what factors the practitioner auditor must consider while examining PFI. This itself, this also can be asked as a 4 marks question. And what are the points PFI must present and disclose? First of all, when you are reviewing PFI, the auditor must ensure the following in the context of presentation and disclosure. In the context of presentation and disclosure in PFI, you need to be careful about the following elements. See that the presentation is clear, informative, not misleading. See that accounting policies are clearly disclosed in the notes to the PFI. If policies are changed from last year, reasons and impact must be disclosed. Assumptions must be clearly disclosed. If assumptions are highly uncertain, that fact must also be disclosed, and the date of preparation should be clearly disclosed, on which date the PFI is prepared, and which date assumptions you have taken. No, assumptions are valid based on a particular date, based on the circumstance on a particular date. Subsequently, those assumptions may not be valid. If results are shown on a range, sometimes prospective financial information, we don't show amount, we show a range bound. Okay, basis for setting it, and it is not biased or misleading. See, remember, in a prospective financial information, we don't give report on the numbers, we give report on the assumptions. We talk about assumptions, we report on assumptions, whether assumptions are reasonable or not. If assumptions are reasonable, using this assumption, PFI is prepared or not, we will check. In PFI, sales figure is there. I am not verifying accuracy of that sale figure, whether that sale figure will be achieved or not. I am not saying that. I am talking about assumption. Yeah, PFI, the sales figure is prepared based on this assumption. Whether that assumption is matching or not alone, I will check. I am giving report on assumptions. Typically speaking, in a PFI audit, in a PFI assurance engagement, we are giving report on assumptions. We are not giving report on the ultimate financial information. Then report components. What are the points that we will mention in the report? Actually, in general, we generally see reports in our classroom. In our classroom discussion, we open the reports and then see. But since it's a revision time, that day before exam, so it's very difficult for me to show all the reports and all. So just like an audit report, I hope you have seen audit report, right? Reporting chapter of mine. So just like an audit report, here it's an assurance report on PFI. This will also have the same information. So title will be there, address will be there, identification of information, reference to SCA, and you see opinion will come somewhere at last, in between. Generally in audit report, opinion will come at first. Remember, in entire 3000 series, 4000 of course we don't give any opinion. 2000 series, in both these cases, opinion comes somewhere in the middle in the audit report. In the report of the practitioner, middle somewhere it will come. Why? Because 3000 and 2000 series standards were not yet updated. Getting it? These standards were released somewhere before 2016, and before that time they have released. Whereas if you see 800 series now, opinion comes at first, title, address, then directly opinion, which is in line with our 700 format. Whereas 3000 series and 2000 series, opinion section of the auditor, conclusion section of the auditor will come somewhere in between. Very soon, 3000 series and 2000 series will be amended. Probably May 26 attempt onwards, this will be amended. For May 26 for May 26, April 26, and Jan 27, 3000 and standard through 2000 standard might be amended. That's what I'm expecting. Okay, fine. Anyhow, opinion. Opinion as to what? Whether PFI is prepared based on the assumption. See, we are giving opinion whether PFI is prepared based on assumption. We are not talking about true and fairness of the PFI. Then appropriate caveats, nothing but some disclaimers you should give in the report, which is very important. So sometimes in exam they'll ask you, the auditor, the practitioner must insert appropriate caveats concerning results indicated by PFI. What are the disclaimers he must give? Nothing but this point they'll give. state whether anything suggests assumption do not provide reasonable basis. Here actually this point, this one, and yeah, of course this one, yeah, 3 4 5 6, this one. You must state in the PFI report you are giving, right? It may be a forecast report or projection based report, whatever it is. So state clearly that actual results may differ significantly from projection, and if a range is given, there is no guarantee that actual result will fall within the range. If a PFI is expressed in terms of lower bound, upper bound, like that range, clearly state that the actual result may not fall in this range bound, and you clearly mention that actual results may differ significantly from projections. For projections, clearly state that these are based on hypothetical assumptions, and caution readers against using them for any other purpose other than intended. See, the PFI is prepared for certain purpose. Alert to the users that they are not suitable for some other purpose. And if PFI is not adequately prepared or presented, a qualified or adverse opinion should be expressed or withdraw. If at all prospective information is not prepared in accordance with the assumptions shown, adverse opinion. If assumptions are not at all reasonable, sir, assumptions are unrealistic, completely, straight away adverse opinion or withdraw from the engagement. Either give a modified opinion or withdraw. Remember, if prospective information is not adequately presented, if presentation and disclosure is not adequate in the PFI, assumptions are not clearly shown, accounting policies are not clearly shown, you must give a qualified opinion or adverse opinion. If assumption itself is unreasonable, you should give adverse opinion. MCQ might come very clear, be clear. And that's it. Finally, you need to document whatever the evidence is there to support report on examination. Whatever the evidence that you gathered for giving a report on examination of PFI, you must maintain documentation. And remember, you must maintain know your client. Know your client means the client data, PAN number, all the details also you should maintain. That is important. That is KYC norms. In professional ethics you might have seen KYC norms. That's it. So this is 3400. Now 3402 I will not discuss in this session. I have a separate session for 402 and 3402 put together. That's why you need to discuss or read this topic immediately after 402, because 402 and 3402 are both very closely connected. Okay, so 3402, here the report is done, here the report is given for the purpose of 402 audit. Getting it? So 3402, there is no validity if there is no 402. Simple logic. Okay, so 402 3402, I'm going to do a separate live on that. So inside that in that particular session you can see that. Next 3420. 3420, what is this 3420 is talking about? Just 1 minute. Just 1 minute. Yes, I'll continue. 3420, assurance engagement. Be careful when you're writing headings, it must be completely correct, and headings will sometimes carry marks. Assurance engagement, okay, for what? To report on compilation of pro-forma financial information. Where are you giving it? Included in prospectus. This is included in prospectus. Fine. So what is this? Nothing but this is similar to audit of consolidated financial statements. What happens in consolidated financial statements audit? Holding company financial statements, subsidiary company financial statements will be there. You will apply some consolidation adjustments and the financial statements will be consolidated. Exactly this also. Pro-forma financial information is nothing but a consolidation of two different company financial statements where we apply pro-forma adjustments. Here in 3420, no, here 3420, there is something called unadjusted financial information and there is something called pro-forma adjustments. There is something called pro-forma. Unadjusted, this is pro-forma financial statements or pro-forma financial information. Actually, the standard uses the word information. Pro-forma financial information. Pro-forma financial information. Whereas CFS, consolidated financials, what happens there? Holding company financial statements, subsidiary company financial statements, you will apply consolidation adjustments. So by applying consolidation adjustments on holding company subsidiary, you will prepare consolidated. Here by applying pro-forma adjustments on unaudited financial information of acquirer company, unaudited financial information of acquiree company. There are two companies. One is buying company, another one is selling company. So generally the pro-forma financial information is prepared by buying company, nothing but acquirer company. Selling company is acquiree company. Buying company to buy this other company. Suppose acquirer, if this company want to buy another company, further the company need funds, further the company want to go for public issue, they want to tell the public that if at all we acquire the other company, this is how our financial position will be, this is how our financial performance will be, like that they want to show. So pro-forma financial information is nothing but financial information shown at a past date. If at all acquisition is already completed on the date, this is the very popular pro-forma financial information. Getting it right now? Now, very simple. How this pro-forma financial information shall be prepared? Is there any applicable financial reporting framework? Actually, it is called as applicable criteria. It's actually called as what? Applicable criteria. Is there any criteria for preparing pro-forma financial information? There is no criteria for preparing pro-forma financial information. SEBI in India has given some guidelines on pro-forma financial information. Those guidelines can be followed by those who are preparing pro-forma. We as an auditor has to check whether the pro-forma financial information is prepared using the criteria which is suitable or not. This is what our duty here. What is our responsibility in this particular report, in this examination, when we are assurance engagement to report on pro-forma financial information, what is our duty? Our duty is to report on whether pro-forma financial information is prepared in all material respects in accordance with the applicable criteria or not. That's it. This is what our objective. Look at. So what is the objective? What is the objective? The entire objective: ensure that pro-forma information is compiled by the responsible party. Who is the responsible party? Generally buying company. Buying company is called as acquiring company. Acquirer. Better. The word is acquirer. Acquirer. R-E-R. Acquirer. Other company is called acquiree. Okay. Acquirer company is the one generally who prepares the pro-forma financial information. That is the responsible party. So what is the objective of the auditor? Ensure that pro-forma information is compiled by acquirer company in all respects based on applicable criteria. So based on applicable criteria, did they prepare PFI correctly or not? Check out. What is applicable criteria? We will discuss that. What is applicable criteria? All that we will discuss that. Okay, we will come back to it. So applicable criteria, and finally provide a report based on the findings. Now compilation, this itself can be asked as a 3 marks. Write about compilation of pro-forma information. They'll ask you directly. Write about compilation of pro-forma financial information. Who will have to compile? Responsible party. So responsible party gathers and present financial information to show the impact of a significant event or transaction on unadjusted information as if it has occurred at a selected date. Suppose as on 31st March 2025, if at all, see, actually our company want to buy another company. This will happen somewhere in the December 2025. But if at all this particular acquisition happened at an earlier date, 31st March itself, if a significant event or transaction like my company acquiring another company, if this transaction happened at 31st March 2025 itself, how the financial position would be if I want to show that impact? That financial information is called as pro-forma. Pro-forma is not a real financial picture. It's an assumed financial picture. Remember, that is different from prospective. Prospective is future. Pro-forma is based on past. Now, so what are the steps involved in compilation? Identify the source of unadjusted information. Source of unadjusted information is nothing but acquirer financial statements, acquiree financial statements. Now onwards I will use the word RER, acquirer, REE, acquiree. So acquirer financial statements, acquiree financial, nothing but buying company, selling company, both the financial statements. That is the source for information. Okay, and from that we will extract the information that we want. We will extract the information. Now once you extract the information, apply consolidation adjustments. Nothing but here we call it as pro-forma adjustments to unadjusted information based on the purpose, and finally present the information present the information, Pro-Forma financial information with all necessary key disclosures. That's it. These are the steps involved in compilation of Pro-Forma information. Now, what is the practitioner responsibility? This itself can be asked as a straight 4 marks question. Okay, what is the responsibility? Very simple. I am not responsible for compiling. Hello, I am not here. Management will prepare it. This is the responsible party duty. Yes or no? The practitioner's sole responsibility is to report. My duty is what then? Report whether Pro-Forma information is compiled in all respects based on applicable criteria. Here, we provide a reasonable basis. It is a reasonable assurance engagement whether applicable criteria used to compile Pro-Forma information, is it reasonable or not? We need to check. What is applicable criteria? I already told applicable criteria is used. Applicable criteria is nothing but you prepared Pro-Forma information, right? Based on what? How you prepared it? You presented in some format, right? Financial reporting framework, right? That is applicable criteria. The criteria which is used by responsible party to compile Pro-Forma. For example, no, consolidated financials you are presenting. Some accounting standard 21, 27, 28, normal accounting standards, and some Ind AS is applicable. Yes or no? So, consolidated financials you are preparing based on some accounting standard. Pro-Forma financial information is prepared based on some criteria. Exactly. So, these criteria may be established by standard setting organization, some standard setting organization like accounting standard board, international accounting standard board, or this criteria would have been given under the law, or this criteria would have been given under regulation like SEBI, or the criteria is developed by responsible party itself if there is no established criteria. Suppose if established criteria is not at all there, then responsible party will design the criteria. In such a case, you have even more further responsibility. If there is no established criteria, whether the criteria developed by the responsible party, that criteria, is it proper or not, you need to check. Next, what are the steps involved in this engagement? What are the steps? Generally this question may not be asked, but if at all they ask 3 marks question, what are the steps? First, I need to accept the work. Then I need to plan and perform the work. I need to get written representation. I need to form the opinion. I need to give the report. Simple. Now, engagement acceptance. When will I accept a Pro-Forma financial information related engagement? When will I accept an engagement to report on Pro-Forma financial information which is to be included in prospectus? When will I accept that engagement? First one, see that I have necessary capability and competence. Remember, this is what they are in the SQC also. A similar requirement is there in SQC also. So I need to check whether necessary capability and competence is there. Whether can I do this? By the way, I will show you. This is one company which prepared. There is a company called SJS Enterprise. There is a company called Plastic. SJS Enterprise is acquirer company. This is acquiry company. Now this company is preparing. They are doing some Pro-Forma adjustments and Pro-Forma condensed financial statement they are showing. Okay, they are showing Pro-Forma condensed financial statements, nothing but summary financial statements. So it's an 810 and 3420 put together. Getting it? Fine. So this is how generally consolidation processes happen. Two companies financial statements will be there, consolidation adjustments will be done, final figure will be there. So exactly. So this is one report. You can find it in the Google if at all you want to see that. So KPMG have given an assurance report on this. KPMG have given an assurance report on this. This report is in 2021. Okay. So I'm just showing you if at all you want to. Okay. Now when can I accept the engagement? See whether do I have capability, competence. Knowledge and discussion with third party, responsible party. See that criteria is suitable and Pro-Forma information is not misleading. See that ultimately Pro-Forma information is prepared in the manner which is required for the user. It is not misleading. And see that applicable criteria is correctly applied, suitable or not. And then this third point not required. Now if unadjusted information or acquire or divest information has been audited. For example, acquirer financial statements, acquiree financial statements, they are already audited or either they were reviewed and where there is a modified opinion or emphasis of matter paragraph. That SJS, acquirer company financial statements, acquiree company financial statements, we use those two financials. That is called as unadjusted financial information in this standard. In this standard, we call them as unadjusted information. On that, we apply Pro-Forma. Now, on the unadjusted financial information, nothing but the financial statements of independent these companies. Some modified report is there. Modified opinion is given or emphasis of matter paragraph is given. So consider, think whether that reference has to be given in the report that you are giving on Pro-Forma financial information. So you are giving a report on Pro-Forma. Should I include emphasis of matter paragraph, modified opinion, which is included in acquirer company financial statements, acquiree company financial? So just check about it. Suppose Our entity means what? Selling, buying company, responsible party. Suppose if the entity historical financials, so they were never audited, yes or no? Determine whether practitioner can gain sufficient, the financial statements, unadjusted financial information is there, right, which is extracted from the financial statements of the acquirer company. That acquirer company financial statements were not audited. In such a case, see whether you can gain sufficient understanding of the financial reporting framework. See whether that financial statements are reliable or not, whether that statement information is reliable or not. Same way, sir, acquiry is there, their financials were not audited. Same, see whether financial reporting practices, will you get an understanding or not, check out. And finally, enter into an agreement. So finally, once you concluded, what you need to conclude, whether you have a competence, whether criteria suitable or not, whether audited financial statements contains any modified report or modified opinion, whether they were not audited. So after considering all that, get an enter into an agreement. If applicable criteria is not publicly available, see that this is adequately disclosed, and confirm that responsible party is accountable. Responsible party is responsible for compiling pro forma based on criteria. And not only that, responsible party should give me access. They should give me access to what? Access to all the documents, additional information, access to the entity, nothing but acquirer company staff. Not only that, access to, if required, access to individuals within the selling company in a business combination. So these are the rights of the practitioner. Sometimes in exam they'll ask you the 7th point alone of a 4 marks question, when while accepting an engagement to report on pro forma financial information, the practitioner has to agree with the responsible party on few things. What are the various terms on which practitioner has to accept these points? That's it. Next, finally, once you accepted the audit, once you accepted the engagement to report on pro forma financial information, what is the work that you need to do? Planning and performing of an audit. The practitioner must assess whether applicable criteria is suitable and see that pro forma information is compiled in all respects based on criteria or not. How responsible party compiled, check out. Sources, get an evidence about from where the unadjusted financial information is extracted. Suppose if there is no audit report is existing on the source, perform procedures to confirm the information is right or not. Appropriateness, ensure responsible party has properly extracted. Get an evidence on appropriateness of pro forma adjustments. I told you, pro forma financial information is nothing but what? Pro forma financial information is nothing but what? Unadjusted financial information. Unadjusted financial information plus pro forma adjustment. Unadjusted financial information is what? Acquirer financial statements, acquiree financial statements. Yes or no? This is unadjusted. So now what are they saying? Get an evidence on the appropriateness of source, whether the source is reliable or not. Check. Appropriateness means what? Reliability and relevance. Appropriateness means what? Reliability and relevance. Meaning, if no report, for example, on this there is no audit report exist, see that, perform some audit procedures to confirm its appropriateness. See that information is correctly extracted and see that adjustments are properly done. See that adjustments are properly done. Then only pro forma financial information will be proper. That's it. I hope this particular formula will give you a clear clarity on understanding that. Next, pro forma adjustments. Pro forma adjustment means what? Sir, what is a pro forma adjustment? This is an adjustment to unadjusted financial information, which includes adjustments illustrating impact of event or transaction as if it occurred at an earlier date, ensuring consistency with applicable financial reporting framework and accounting policies. Presentation, evaluate presentation and review other information. Suppose pro forma financial information is included in prospectus. Prospectus contains some other information. 720 procedure you should apply. Yes or no? Practitioner must review other information in the prospectus to identify any material inconsistency. So in the prospectus, other information is there, right? That other information, is it inconsistent with pro forma information? Identify that and then address 720 procedure. Do 720 procedure accordingly. Next, I hope you are clear, able to get clarity. Yes. Next. Yeah, I think perfect. Yeah. Finally, you must get a written representation. What representation? Generally, what representation we get? A responsible party. Practitioner shall require representation from responsible party. Responsible party shall give representation that they identified all pro forma adjustments. They identified all adjustments and adjusted all whatever is required, and which will illustrate the impact of a significant event or transaction as if that event or transaction happened at an earlier date. Pro forma information, compliance with criteria, that too. Responsible party has to give one more. They need to mention that pro forma information is compiled based on applicable criteria. See that all adjustments are done, and see that pro forma information is compiled using these adjustments based on applicable criteria. That's it. Finally, you will give opinion. Generally, we give unmodified opinion. When do we give unmodified opinion? Pro forma information is compiled. Pro forma information is prepared in accordance with applicable criteria. Then we generally give unmodified opinion. Suppose if pro forma information does not meet applicable criteria, if pro forma information is not prepared based on applicable criteria, so issued pro forma information does not meet applicable criteria in all material respects. Suppose if at all it does not prepare, then you will give modified opinion. Generally, generally law or regulation, if at all they allow modified opinion, then you give modified opinion as per 705 framework you will follow. Then suppose you want to give modified opinion, but SEBI does not allow. SEBI clearly prohibits that a pro forma financial information report shall contain only unmodified opinion. Modified opinion is not permitted. But mistakes are there. In the pro forma information is not prepared as per applicable criteria, I can give modified opinion. In such a case, ask the party to make necessary changes. Ask the responsible party, your responsible party, your pro forma information is misleading. Please make changes. They are not making changes. Withdraw from the engagement, because you are supposed to give modified opinion, and the lawyer is not allowing you to give a modified opinion. He is not amending it. So withdraw or take a legal advice. That's it. Now, can I give emphasis of matter paragraph? Yes. A practitioner can also include emphasis of matter para to highlight significant issue fundamental to the user's understanding of pro forma. The paragraph must only refer to matter clearly disclosed. The practitioner must obtain sufficient appropriate that it does not affect all that. Remember, emphasis of matter paragraph can be used to refer to any matter which is disclosed in pro forma information. In pro forma financials, some important points for that. I can highlight it in emphasis of matter paragraph. That is one. Two, when I can use emphasis of matter paragraph, condition provided the matter does not affect nothing but the matter is not materially misstated. Very simple. The matter is not materially misstated. And finally, the report. So in the report, you need to mention a statement. You need to mention some statements. Statement that engagement was performed as per 3420. Statement that it's a reasonable assurance engagement and involves procedures to assess whether applicable criteria provide reasonable basis. Reasonable assurance engagement involves where we are performing some procedures to identify whether applicable criteria is reasonable or not, and the related pro forma adjustments are appropriate or not. Whatever the procedures, generally what procedures we perform to get this reasonable assurance? The procedures that we perform depends upon nature of the entity, type of event or transaction, engagement circumstances. So there is no specific procedure to be performed. It depends upon the circumstance of the engagement. And you need to, how the opinion, the pro forma information has been compiled on the basis of applicable criteria. The pro forma information has been compiled based on the basis stated, and documentation. That's it. You see, opinion comes somewhere at the last. In entire 3000 series and 2000 series, opinion section will come somewhere at the last of the report, because these standards were not yet updated. They were all issued before 2016. Before 2017 they were issued. That's it. So with this 3420 is also completed. I think I have finished it within 40 minutes. Yeah, very good. That's it. So with this 3420 and 3000 both were completed. I hope you have thoroughly enjoyed this particular revision. Wait for the next revision. I'll come back with the next revision. Okay, 402 3402 will start. Thank you. Yeah. So, review of financial information. There is a beautiful chart book which I have. A minute, please. I think, yes, I think it's perfect now. Just a minute. Yes, perfect it is. So, actually, I have developed one chart book also. The work is still going on. So that is the reason I decided not to use this. Almost it is a 10 pages chart notes for review. But anyhow, This itself is already, this goat notes, that something which I already made is already a very refined version. This itself is a fantastic notes. Okay, so directly we'll discuss from this itself. Now I am going to cover only key concepts, but before that, let me discuss exceptional questions in review chapter. You know, in ICA book there are test your understanding questions, right? 1, 3, 4. In TYU 1, 3, 4. These three questions are something different. Like what exactly the different? You see here, you know, there is a company which is which has entered into contract with another company. In that note, there is a condition where this company, Roma, the original company, required to get the financial statements reviewed for a year on a quarterly basis in accordance with financial reporting provisions of a contract. Oh, here the financial statements have to be reviewed as per financial, which are prepared as per financial reporting provisions of a contract. Here the financial statements are prepared using special purpose framework, and those financial statements has to be reviewed. Generally, when you see this particular question, immediately many students what they write, you know, SEA 800 answer also they will write. But look at, they are asking about review. Can the company get its financials reviewed from a professional accountant in practice? Absolutely yes. As per SRU 2400, the professional accountant in practice can accept that an engagement. See, what is 2400 talks about mainly? 2400 talks about engagement to review. Engagement to review historical financial information. If it is historical, that's enough. This may be general purpose financials or this may be special purpose financials, doesn't matter. So these can be reviewed. Next, so that's it. Then there is another question, test your understanding 3, which is also bit exceptional, bit different. You know, here the company machinery and inventories of plant were uninsured, and what happened, there is a massive major fire accident in company and plant and machinery, all that they resulted in massive disruption in the operations. Machinery and plant were not insured at all, leading to substantial losses. The company has disclosed it in interim financial information appropriately. Going concern issue, they disclosed appropriately in the interim financial. The moment it is interim financial information, you should recollect the standard called 2410. If you recollect, SEA 570 is applicable in the context of audit of general purpose financial statements. There, if a material uncertainty related to going concern is there and that is disclosed appropriately in the financial statements, we give unqualified opinion, and in material uncertainty related to going concern, side heading will be there, right? There we draw attention to that point. But 2410 in the standard, this standard is updated long back before 2017. It is not updated. Earlier, no, going concern material uncertainty we have to highlight, right? Because see, going concern, company going concern is uncertain. They honestly disclosed, yeah. You can't give any modified conclusion there. Getting it? In a review, we don't call it as opinion, we call it as conclusion. So you can't give a modified conclusion there. So it's an unmodified conclusion because it's clearly honestly disclosed. So unqualified conclusion on going concern only you can give. But going concern point, something severely they disclosed. Where you will highlight? You will highlight that in emphasis of matter paragraph. You must highlight that going concern issue in emphasis. Remember, this point is not correct in case of audit engagement. In audit report, no. Going concern issue we will highlight in material uncertainty, MURGC, material uncertainty related to going concern para. Whereas in review, material uncertainty related to going concern is highlighted in emphasis of matter paragraph. I already told in 3000 series, 3000 series, 2000 series, the practitioner auditor's report format is different. The auditor's report format is different. So again in 2410, this review of interim financial information is performed by whom actually? Independent auditor of the company only will be giving a report on interim financial information. So emphasis of matter paragraph is the para where you need to highlight this particular point. So that's the reason this is exceptional. Then there is another question. What is this another question? You know, she believes that necessary to make some adjustments to quarterly. Okay, quarterly financial information. The auditor feels that some adjustments are required. She has communicated the matter to CFO and audit committee. Okay, adjustments, what are all adjustments required in financial information? She communicated. No response was received even after waiting for reasonable time. So we communicated what are the modifications required in financial information, interim information, but they're not responding. What options are available to her? You see how the question was given. What options are available? 1. Modify the report. 2. Withdraw from the engagement. See the possibility of resigning from the appointment. You know, it's possible to resigning. So withdraw from the engagement and also withdraw from annual audited audit requirement also. That's it. These are the options available as per SRU 2410. That's it. These are the 3 exceptional different questions on in review. That's it. Now let's begin the actual discussion. We all know review and audit. Review is a limited assurance engagement, you know, whereas you know, so in a review it's a limited assurance, in audit it's a reasonable assurance. In audit, no, we perform extensive procedures, test of control, substantive, inquiry, analytical, inspection, external confirmation, physical verification, recalculation, reperformance, so many we will perform. Whereas in review we perform few procedures, either inquiry and analytical. Only 2 procedures we will perform in review, inquiry and analytical. So review involve few procedures. Few procedures means what? Inquiry, analytical. Whereas in audit we perform so many procedures. So many procedures means what? Apart from inquiry, analytical, what else is there? Inspection is there, observation is there, physical verification, recalculation, reperformance, ledger review, so many were there. Whereas in review we perform only few procedures, inquiry, analytical, that's it. And in an audit we give opinion, whereas in review the thing that we express is called as conclusion. In an audit we call it as unqualified opinion, qualified opinion, adverse opinion, disclaimer of opinion. Whereas in review, unqualified conclusion, qualified conclusion, adverse conclusion, disclaimer of conclusion. We use the word conclusion in a review. In an audit the opinion we give in a positive wording, whereas in review negative wording. In audit, no, in our opinion, to the best of our information, according to the explanation given to us, the aforesaid financial statements are showing true and fair view. Whereas in review, nothing has come to our attention that causes us to believe that the financial statements are not free from material misstatement. Like that we will give. Okay, be careful. Now, first one, 2410. Generally, any organization can get their historical financial information be reviewed by a chartered accountant. So if at all you are appointed to review historical financial information, not interim. If it is interim, 2410 applicable. Normal annual historical financial information you are requested for review, then 2400 standard is applicable. So as per that, I am directly discussing the actual point. Compliance with ethical requirements. I am only discussing exam oriented stuff directly. Okay, here no, you must comply with relevant ethical requirements including independence. Remember, in related services I told independence is not a requirement in related services, whereas in assurance engagement 3000 series, 2000 series, 700 series, 800 series, independence is most important. Okay, and engagement partner is responsible for overall quality. Remember, standard on quality control is applicable even for review engagements as well. Standard on quality control is applicable for audit, special purpose financial statements audit, review, assurance engagements, and even for related services SQC is applicable. That's why you see SQC heading. Quality control for firms performing audit, review, assurance and related services, SQC heading. So SQC is applicable for everything. Then most important, factors affecting acceptance and continuation of client relationship. Suppose if a client is approaching you for conducting a review, what points you will consider when you are accepting this client? Generally, you should not accept in the following cases. Like, there is no rationale. The client is asking financial statements to be reviewed. I asked him, sir, what is the purpose, sir? He don't know anything, sir, just casually, sir. There is no rationale behind the review. There is no user. Not satisfied, there is a rational purpose for the review. Getting it? Or if the law regulation requires an audit, then review is not appropriate. For that client, no, he said, sir, I am a company, sir, registered under Companies Act, sir. As per Companies Act, no, auditor signature is required, sir. That is the reason we are coming to you. Please review. Sir, no. As per the law, audit is required, not review. So there I will not accept. And or second scenario, there is no rationale for review, or review is not the right engagement there. Review engagement is not suitable for the given circumstance. In that case, no, I will tell the client, please sir, this is not suitable, some other work is suitable, I will tell him. Then further, another scenario, so no rationale, I will not accept the review. Review is not appropriate, I will not accept the review engagement. Third one, non-compliance. The practitioner believes ethical requirements, you know, in 2400, instead of using the word auditor, they use the word practitioner, whereas in 2410, auditor word is used. Be careful. See, even if you are using interchangeably, not an issue. I don't think examiner has that much ability. Okay, fine, it's okay. Next, non-availability. Suppose necessary information to perform review is not available with the client. So client is not giving you proper information. That time also you need to check integrity of the client. In SQC, you will be discussing acceptance and continuation of client relationship, you will be gathering some data. That time itself you got to know that client will not give you information, don't accept it. Or doubts about integrity of the management, don't accept the engagement. Limitation on the scope, if at all those charged with governance is imposing a limitation on the scope, do not accept the engagement. That's it. So indirectly, what are the preconditions for accepting a review? Determine whether financial reporting framework used for preparing financial statements is acceptable. Check out. Understand the purpose of the review. Who are the users? Understand. If there is no rationale or review is not appropriate, don't accept it. That's what we have seen. The same point is once again conveyed to you. Further, you will accept an audit preconditions for review. Before you start the review, first agree management responsibilities. What are the management responsibilities? They are responsible for preparing financial statements as per applicable framework. They have to establish internal controls to make sure financials are free from MMS. They have to provide me, the practitioner, information, additional information, unrestricted access to people inside that company. I can talk to anybody. Next, practitioner satisfaction. Suppose if I am not satisfied with preconditions, I will discuss the matter with the top management. I will tell them, sir, I need all that in data. Suppose if issues cannot be resolved, don't accept the engagement. Yes or no? If at all you are accepting because there is a compulsion in law, then don't mention about SRU 2400 because you are doing review as per the law, not as per SRU 2400. That's it. Suppose no, you accepted the review. After accepting, some issues arises. If preconditions do not present after accepting the review engagement, discuss the issue with the top management, see whether issue can be resolved and determine whether you will continue or withdraw from the engagement. In exam, this itself can be asked as a 3 marks question, or preconditions itself can be asked as a 5 marks question. Factors affecting acceptance and client relationship itself can be asked as a 5 marks question. Remember, factors affecting rationale, not appropriate, non-compliance with ethical requirements, non-availability, integrity. These are the acceptance and continuation point. Whereas preconditions for accepting, see applicable financial reporting framework, management responsibilities, practitioner satisfaction, decision, post-acceptance issue. This is something similar to CA Inter 210. Preconditions to audit in 210 standard you might have seen in CA Inter, right? Regarding that. Okay, preconditions, everything is done. Establish engagement letter, give engagement letter, agreeing to the terms of engagement. What is agreeing to terms of engagement? Prior to performance, no, must agree on the terms of engagement with management and top management before starting the engagement. The agreed terms must be in a written letter like engagement letter. And for recurring audits, no, you should check whether engagement letter is required in case of a recurring review. Actually, it's not a recurring audit, recurring review. Further, in this book, no, at many places I have used the word SAAE, sufficient appropriate audit evidence. Actually, audit word is not required. Sufficient appropriate evidence is the right wording. Sufficient appropriate evidence. In MCQ, they might test this point also. So the reviewer shall obtain sufficient appropriate evidence. That's the right wording. Sufficient appropriate audit evidence is wrong. Be careful. Okay, next. Suppose no, after you accept the engagement, management is requesting to change certain terms. If there is a reasonable justification, you know, the practitioner must not agree to a change unless there is a reasonable justification. Changes in engagement. Suppose no, if management is asking to change engagement to one with no assurance, like they're asking you to reduce less than, limited assurance itself is a lower level of assurance. Anything below lower means no assurance. Practitioner evaluate whether it's justified or not. If at all you agreed and revise the terms and conditions of the management, then record the new engagement terms in a new engagement letter. Then now once you accepted the review, now you need to perform. While you are performing, determine materiality. Yes or no? So determine materiality and apply that when you are designing and applying audit procedures. You know, the judgment of materiality is generally same regardless of level of assurance. Whether it's a reasonable assurance or limited assurance, that doesn't matter. You can happily apply SA 320 logic. Determining materiality, performance materiality, overall materiality, the logic is mostly same. And practitioner will revise the materiality whenever new information arises. Further, get an understanding. Practitioners gains an understanding of the entity and its environment and identify potential areas where material misstatement. So when you're performing the audit, first decide materiality, get an understanding, design and perform procedures. What procedures we will perform? You know, we will perform inquiry analytical procedures. In a review, we perform limited procedures, fewer procedures, nothing but inquiry and analytical procedure. What are inquiry and analytical? First one, gather sufficient evidence for forming a conclusion. You need to give a conclusion. For that you need a sufficient evidence. For that you perform inquiry analytical, where you will cover all material items of financials. You focus on areas where misstatements likely to arise. What are the areas misstatements likely to arise? In risk assessment you will understand. Then procedures should be designed to meet objectives of the engagement. Further, sir, inquiry analytical, only these two should be performed? No, he may also perform other procedures like inspection, observation, recalculation, if at all they are effective or necessary in the engagement. So now tell me, in a review, no, you perform primarily inquiry analytical. You generally don't perform other procedures. Sometimes you perform other procedures. Just because you are performing other procedures also, additional procedures also, does it change the objective of the engagement that which you have accepted? No. Performing other procedure does not change the objective. Still you need to get limited assurance only. You should give limited assurance only. Now practitioner may review accounting records also to identify unusual transaction. This is called inspection. Just because you are doing inspection, it is not again called as audit. It is still review only. Then what is inquiry? Inquiry means what? Asking information from management, accounting estimates, related parties, unusual transactions, frauds, subsequent events, going concern, all that. Yes or no? Sometimes, no, we also inquire non-financial information like what are the decisions taken at the meeting, communications received by the company from regulatory bodies, matters arisen during other audit procedures. And whenever you are getting response, no, look at the reasonableness and consistency of the response. Sometimes, no, in exam they'll ask you, in a review, inquiries consist of only financial information. No, wrong. Inquiry can also non-financial information. This itself can be asked as a 3 marks question. Be careful. Not only this, auditor will also perform what? Analytical procedure. So get the data from the company accounting system and perform analytical procedure. Analytical, what happens? We logically see whether the numbers are logical or not. Is there a relationship between the numbers and cash flow? All that. Why inquiry? Why analytical is important? This is asked once in 4 marks question. Once they have asked regarding inquiry for 4 marks question. Only 2 attempts were happened after this standards were made applicable in CA final May 24, November 24. Only 2 exam papers were there. Okay, so this was asked in one of the attempt. Why inquiry is important? Inquiry, you know, generally through inquiry we will get evidence about management's intentions. For intentions, especially if you want to know intention of the company, intention of the management, inquiry is the principal source of evidence. Yes or no? Generally information on management intention is limited. In that case, past history I will see whether whatever intentions they told last time, in the previous years, whether they fulfilled or not. What course of actions do they have ability to satisfy the intention they have? That's it. And skepticism is essential. Inquiry will help the practitioner's understanding to update. As a practitioner, I can update understanding of the company, all this only through inquiry. Inquiry is nothing but talking to the people here. Tell me, without talking to the client, without talking to management, can you do audit? Can you do review? It's impossible. So inquiry is the principal source of evidence. Then what is analytical? Analytical procedures will help you to update understanding of the entity. It helps identify inconsistencies, risky areas and all you can identify only through analytical procedure. It will give you supporting evidence for inquiry. And analytical, it serves as an additional procedure if you suspect any misstatement. Various methods can be used, like a simple analytical to complex statistical. Getting it? That's it. And there are some specific circumstances that you need to address in in a review. In this, not all the specific circumstance, any 3 points: related party, going concern, like that. Related party, auditor has to alert for information that may indicate related party relation not identified by the management. Be careful. Company would have not identified some related party relationships and transactions. Be careful about those transactions. If significant, also the auditor, if transactions are there outside normal course of business is identified, inquire with management about nature of this transaction and what is the rationale. If some transactions with related parties are not in ordinary course of business, why they were not in ordinary course, what is the rationale, inquire that. So this they may ask you specifically. In a review, the auditor has to focus on some specific circumstances. They are related parties and going concern. What are the points auditor has to look into? 2.5 mark, 2.5 mark, like 2.5 marks, 5 marks question they can ask, or 3 and 3, 6 marks question they can ask, like this. Okay, now going concern, during the review, assess ability of the company, ability of the entity to continue as a going concern. Inquire with management whether do they have any plans and are they feasible or not. Evaluate management response, whether see that the financials are prepared on going concern basis or not. Consider management response, all that. Further, fraud. If there is any indications of fraud or non-compliance, communicate this to appropriate level of management. And practitioner must consider how management assessment of fraud affect conclusions on the financials and need to report it externally. See, if any fraud and non-compliance is there, check, identify nuclear. Okay, check whether do you have any responsibility to report the fraud identified, non-compliance identified to any third party. Then that's it. Only these 3 points are important, only these 3 points are important in specific circumstances. Suppose no financials are materially misstated, what extra you have to do? If practitioners believes that financial statements are materially misstated, conclude that matter is not likely to cause a material misstatement, determine whether it is causing material. Suppose no you are believing that financials may be material, you are suspecting a material misstatement, then what you have to do? Perform additional work. 2 conclusions you should arrive. Yes, financial statements are not materially misstated. 2, financial statements are materially misstated. Either conclude that matter is not likely to cause a MMS, or determine whether it is likely to cause an MMS. Either MMS is there or MMS is not there. Conclude it. What additional procedures? Do additional inquiry, do analytical procedure, gather more evidences, other procedures perform. Examples of additional procedures, for example, in a trade payables, additional procedures, for example, a review of trade payable shows large amount of overdue payment. When you are reviewing accounts receivable, debtors, some large amount of receivable is pending. This raises concerns that financial statements, you are getting a doubt that, oh, provision for bad and doubtful debt is materially misstated. You are getting a doubt. For that, what you need to do? Ask management regarding uncollectible. Possible outcomes is what? Perform additional work. After performing additional work, what could be the possible outcome? 1, no issues were there. Yeah, the debtors amount is correct. 2, financial statements are clearly misstated. Provision is not calculated correctly. 3, uncertainty means even after performing additional work, you are still unable to get evidence. In that case, what happens next? Again, if additional procedure resolve the issue, you can either conclude 1 or 2. What is 1 or 2? You can either conclude 1 or 2. Yes or no? Conclude that the matter is materially misstated, or not. Or conclude that it is not materially misstated. Issues found like this. Yes or no? If the issue is unclear, continue performing additional work. If a clear conclusion cannot be reached even after performing so much amount of work, you cannot provide an unmodified opinion. You can't give an unmodified opinion. At that time, what you will do, you will either give a disclaimer of conclusion or you withdraw from the engagement. Subsequent events. This itself can be asked as a 4 marks question. This itself can be asked as a 4 marks question. They'll ask you these 2 points put together. Under what circumstances a practitioner when performing a review will perform additional procedures, and give an example of additional procedure. Under what circumstances practitioner will perform additional procedure? What do you mean by additional procedure? Give with an example. 4 or 5 marks question. This 3rd and 4th point, 1, 3, 4, 1, 3, 4, these 3 put together, a question can be asked for a 4 or 5 marks question. Be careful. Next, subsequent event. This itself, you are appointed as a reviewer for performing review of interim financial historical financial information. If at all historical financial information word is used, annual financials, then 2400. Interim financial is used, then 2410. Then if at all practitioner get to know that any subsequent events between the date of financials and practitioner report date, they must ask management to correct it. Generally, you are not required to perform any procedure after you gave a review report. However, if you get to know something after the date of report, if at all you know this, you would have amended the audit report, then discuss with management, see whether financials require amendment. If needed, how management is going to address it. Management is not amending, they're refusing, then notify the top management not to issue financials to third parties, because according to you there is a material misstatement. If the financials are issued without amendments, you have to take an appropriate action. This is exactly copy paste from SA 560. Next, written representation. Just like in audit 580 standard, even in review also you must get written representation. Yes or no? Written representation is a crucial source of audit evidence. If management changes or does not provide, it indicates a significant issue. Suppose management changes, like the management have changed and they are saying, sir, we are new to the company, we don't know anything, so I can't give representation, like that they're saying, or they're not providing, it's a significant issue. Communicate with top management. If they are also not responding, give a modified conclusion. Okay, requesting written rather than oral representation can prompt the management to consider the issue more rigorously. If at all I'm asking written, no, they will consider more severely and then give a proper data. Then responsibilities. What will be there in the written representation? Practitioner must request management to provide representation that they have fulfilled their responsibilities for preparing financials as per applicable framework, that they have fulfilled giving all information to auditor and ensuring that all transactions are recorded, and if required by law, that's not required, only these 3 enough. Yeah. Representation. Sometimes we also ask representation on additional matters. What are the additional matters? Regarding related parties, regarding frauds, regarding non-compliances, regarding going concern, regarding subsequent event, regarding non-monetary transaction and transactions with no considerations, regarding material commitments and contingencies, all that. So they may ask you, they may give you a question, write about representation in a review, and what give few examples. Give few examples of additional matters where written representation can be obtained. Like this, they can ask you, suppose if management is not providing requested written representation, discuss the matter with the next level management, reevaluate this integrity. All these days I thought they're cooperating, today suddenly they're not giving representation information. Representation means I'm asking information, they need to give me, now they're not giving me. Reevaluate whether they're really honest guys or not. Take appropriate action. Take appropriate action. If management does not provide, practitioner may disclaim the conclusion or even withdraw. If requested written representation is not provided, I can either give a disclaimer of conclusion or I can even withdraw from the engagement. That's it. See, when you're doing this revision, after finishing one standard, pause the video and read from your book. That is how you will really make use of this revision. That is how it will be very powerful to you. Next. Finally, okay, you performed analytical, you performed inquiry, all that, you gathered so much of evidence, evaluate it. The practitioner must evaluate whether sufficient appropriate audit evidence, actually here audit word is not there, sufficient appropriate evidence has been obtained or not. If not, you felt sufficient appropriate evidence is not obtained, sufficient audit evidence you did not get, perform additional procedures until you get sufficient evidence so that you can form a conclusion. Suppose if evidence is insufficient, you have not obtained expected evidence, if evidence obtained is not sufficient to form a conclusion, consider other procedures so that you can gather the evidence, extend the work, perform additional procedures. Sir, additional procedure is not possible, sir. Determine what is the effect on the report. Discuss the limitation. See whether there is a limitation on the auditor scope or not. Check out. Inability. Sir, if practitioner cannot perform specific procedure but obtains sufficient procedure through other procedure, it does not constitute. See, ultimately this is common sense. MCQ important. Through inquiry analytical you did not get evidence, through inspection you got the evidence. That's it, you got the evidence, right? Ultimately that means you got sufficient appropriate evidence. Somebody is asking CA inter tax, please go and watch tax marathon, already given. Next, limitations on the scope imposed by management may affect the review. So that's it. So here in this this particular second point can be asked as a question. In a review, practitioner may have not obtained expected evidence. What are the consequences? What should be the next step when practitioner is unable to obtain expected evidence? Like this, they can ask you as a 4 marks question. So 2, 3 and 4. That's it. So 2, 3, 4 points you need to write specifically. Okay, that's it. Then finally, you need to form a conclusion. Okay. So the practitioner must consider impact of uncorrected misstatements identified, qualitative aspects of accounting practices. Before you form a conclusion, this is there even in 700 also. Before you form an opinion, here before you form a conclusion, see what are all the mistakes that you identified and not yet corrected. What is its impact? 2. Qualitative aspects check out. Further, if the financial statements are prepared using fair presentation framework, consider how financials are overall presented. What is the structure? What is the content? Whether related notes and all giving true and fair view. Whether they are exhibiting underlying transactions in a true and fair manner. Check out. Finally, conclusion. The practitioner, whether unmodified or modified, it depends upon the financial reporting framework. Now, unmodified conclusion in practitioner's report. This is not required from exam point of view. Modified conclusions. Yes, this is important. Modified conclusion. You will express a modified conclusion in two circumstances. Financials are clearly materially misstated. 2. You are unable to obtain sufficient evidence to form a conclusion. In these 2 cases, you will give modified conclusion. If financials are materially misstated, the practitioner shall give qualified conclusion. If the misstatement is material but not pervasive, suppose if it is both material and pervasive, you will give adverse conclusion. At that time, side headings will be given. A qualified conclusion, adverse conclusion, like that, side headings will be given. Then that is not required. Basis for conclusion para. Again, whenever you are giving a qualified or adverse conclusion, in the basis for conclusion para, you must clearly describe and quantify the impact of the specific amount, explain how the disclosure is misstated, describe the nature of omitted information. If at all misstatement is omitted information, describe that. If the misstatement is due to disclosure, how the disclosure is misstated. If the misstatement is on a specific amount, describe what amount is misstated, quantify it unless it is impracticable. This I even explained much more detailed in 705. I hope many of you would have watched my reporting chapter, audit reporting. Inside that in 705, basis for modified opinion para, how it will be modified, there I clearly covered. The same thing here also. Then sometimes you will give modified conclusion because you are unable to obtain sufficient appropriate. This itself can be asked as a separate question. Write about conclusion on reporting in case of inability to obtain. If practitioner cannot form conclusion due to insufficient evidence, express a qualified conclusion. If possible effect of undetected misstatement is material but not pervasive, disclaim the conclusion if the possible effect is both material and pervasive. Just 1 minute. Just 1 minute. Yeah, so that's it. Further, management, if at all, imposing limitation so that you are prevented from obtaining sufficient evidence and the matter is going to be material and pervasive, withdraw from the engagement if withdrawal is permitted. So wordings of the qualified conclusion para, this is irrelevant, not required. Finally, elements of the practitioner report. First, title will be there, address will be there, intro para, management responsibility, practitioner responsibilities. You know, they may ask you this question directly. What are practitioner responsibilities in a review engagement? A responsibility is to express a conclusion, describe the review of financials, describe that it's a limited assurance engagement, it involves inquiry and analytical procedure, describe that procedures are less than audit, and give a conclusion para, yes or no. And if the conclusion is modified, with a modified conclusion, describe the matter giving rise to modification in the basis for modified conclusion para, yes or no. And also give a reference to ethical requirements, all that. Date of practitioner report shall not be earlier than the date on which you obtain sufficient evidence and shall not be earlier than the date on which financial statements are approved by respective authority. That's it. Emphasis of matter. Can a practitioner give emphasis of matter para in a review report? Absolutely yes, no problem at all. Placement. You know, in audit report, no, emphasis of matter paragraph will be placed. Opinion, basis for opinion, then emphasis of matter. Okay. Whereas here, no, emphasis of matter paragraph will be placed immediately after paragraph where conclusion paragraph will be there, right? Immediately after that, emphasis of matter paragraph will be given. Placement. This itself can be asked as an MCQ. Remember, in emphasis of matter, what matter you can highlight? Only that matter in the financials which is free from MMS, on which you already got sufficient appropriate evidence. That only you can highlight. Then, can practitioner use other matter paragraph? Absolutely, where he can talk about information not presented in the financials, something else. You want to talk about branch reviewer responsibility, you can talk about that. Then, documentation is important. Okay, what you have to document? What is the nature, timing, extent of procedures performed, who performed the work, when the work was completed, who reviewed the work, result of the work performed, and conclusions you reached, any significant matters that have been arisen. So all that. Further, discussions with top management of significant matters, that also has to be documented. If inconsistency is found, document how the inconsistency is addressed. That also you should document. That's it. 2400 is completed. Oh my god, very tough. In the sense, it's actually easy. The 2000 series is dead easy. Those of you who are very good at 700 series, 2000 series is nothing. Okay, just that in 2000 series, old report format we will follow. Before 2017 there is a reporting format, that only we are following, because these 2400 2410 standards were not updated in the past almost, I can say, 10 years. They were not updated. Whereas auditing standards, no, 700 701, they were all updated in 2018. Fine. 2410. Review of interim financial information performed by independent auditor of the entity. The company has an independent auditor. Generally, this standard is very popular in listed companies. In listed companies, the stat auditors will give interim review report on interim financials, quarterly financials. They use this standard only. Yes or no? So this standard is applicable when independent auditor is reviewing interim financial information as a part of their overall audit of financial statements. Then, objective of an engagement to review. Objective is also not required. That's not required. It's okay. Agreeing to the terms. This is most important. Okay, agreeing. The auditor, you see entire 2410, the word used is auditor. Why? Because independent auditor is performing this review. Therefore, the person who is doing this review is auditor. Whereas in 2400, he is not auditor. He is a practitioner. We call him as what? Simply practitioner. Auditor and client must agree on terms of engagement, which are usually recorded in an engagement letter. So what will be there in engagement letter? Nature of the engagement, objective and scope, management responsibility, audit responsibility, what is the level of assurance required, nature and form of the report. The same thing is there even in 210 standard also. Then obviously, most important thing in a review of interim financial information is obviously understanding the entity and its environment. So the auditor has to obtain understanding of entity and environment, internal control, as a part of annual audit, as well as interim financial. So where when you're understanding the entity, you identify areas where potential misstatements will happen and likelihood of their occurrence, and you will do inquiry, analytical and other procedures so that interim financial statements, are they prepared as per applicable framework or not, you will see. Remember, in a review you will only do limited procedures, fewer procedures, inquiry, analytical. If required, other audit procedures you will perform. Sir, same auditor is doing audit. Last year also I only conducted audit. Should I once again understand the entity? No need. Just update. If same auditor, if the auditor has already audited annual financials before, then they have already have an understanding of the entity. That time you just have to update your understanding. Yes or no? The auditor also understand any difference between any differences in internal control between interim and annual financial. Procedure. Remember, there is a point called 143 subsection 3 clause I, where auditor has to give opinion on operating effectiveness of IFC. This opinion is not required in case of a review engagement. Remember. Next. So procedures to update understanding. Okay, suppose I'm already an auditor. What are the procedures I will perform to update my understanding? I will read documentation of the prior period audit. I will assess the risk. I will read the most recent financial statements. I will consider materiality. I will evaluate issues related to internal control. I will inquire with management. I will ask management about any changes in business activity. I will ask any significant changes in internal control. I will ask management how the interim financials were prepared and reliability of the underlying records. All this I will perform to update. This itself can be asked as a 4 marks question. Second and third point put together. You are already an auditor of the entity in the prior period. This year you were requested to do review of interim financial information. For that you need to obtain an understanding of the entity and environment. So since you are already an existing auditor of the entity, you just have to update the understanding. What are the points you will update? They will ask you in this third question. In this third point, there are so many points, right? A to L, approximately some 10, 12 points, but they write any 5 points you have to write in exam. That's it. Sir, I'm a newly appointed auditor. Then you should understand the entity and environment, including internal control, for both annual audit purpose as well as interim financial information purpose. The understanding will help you to do review of interim financial information. This understanding will help you to do audit of annual financial statements. Next. Obviously, even in 2410, review of interim financial information, you do an inquiry, you do analytical procedure. A review usually does not require testing like inspection, observation, confirmation, that and all not required. It just involves inquiry with responsible person and analytical procedures. Whether is there something wrong? Is there anything wrong? Is there anything something like illogical? That I will try to identify. The auditor understanding of the entity and internal control. Okay, this is okay, not required. Procedures to be performed. What are the review procedures? Read the minutes from the meeting. Identify matters that may affect interim financial information. Inquire with management about various matters, including, these are all actually subpoints, whether financial information is matching with financial reporting framework. Are there any changes in accounting principles? Are there any new transactions? Are there any uncorrected misstatements? Any unusual situations? What are the assumptions about fair value measurements, related party transactions, changes in commitments and contingencies, complaints with the debt terms and conditions, any frauds or suspected frauds, allegations, non-compliance with laws and regulations, all that. Finally, you apply analytical procedures to identify, these are all subpoints actually. These are all subpoints. I will tell my team to rectify this. Yes, E point onwards. Yes, E point to S point. These are actually subpoints. It's okay, no problem. Then, so read interim information to see whether the interim financial is not prepared in accordance with applicable framework. I think this is enough. Procedures to be performed, no? The subpoints, inquiries include various matters. What are all the various matters that you inquire? Any 5 points you read, that's more than enough. Next. In a review of interim financial information, you will also inquire about subsequent event and going concern. Okay, subsequent events. See, ask management whether subsequent events are identified, whether do any adjustments or disclosures required. The auditor should also inquire whether management assessment of going concern, yes or no. The auditor should inquire if management assessment of going concern has changed, and if even suggest about doubts about it, the auditor should ask management plans to consider and what is the adequacy of the disclosure. If a material adjustment is questioned, the auditor should make additional inquiries and resolve the matter. Evaluation of misstatements identified, that's not a big deal, not required. Get management representation, written representation. Management must acknowledge responsibility for designing and implementing internal control. Management confirm that interim financial information is prepared as per framework. If at all uncorrected, some mistakes are identified which are not corrected, management says that they're immaterial. Get a representation that they're immaterial. Yes or no? And a summary of those uncorrected misstatements which are immaterial, no, please get a list of that to the representation. And management has to give a representation that they disclose to the auditor any fraud or suspected fraud. Get a declaration from the management representation that management disclosure the result of their own risk assessment process to the auditor. Management should give a representation that they disclosed all the non-compliances, frauds, everything to the auditor. That's it. Any 5 points enough. Getting written representation, internal control point, risk assessment point, fraud point, non-compliances point. That's it. Subsequent, get a representation that management has disclosed all the subsequent events information to the auditor which require adjustment, which require disclosure. Next, what about other information? Interim financial information, when listed companies giving, when a listed company is publishing quarter results, they will be publishing in some document. That document might contain other information also. Same 720 standard will apply. Yes or no? Auditor has to identify inconsistency between accompanying information. In SA 2410 it is called as accompanying information. That's nothing but other information as per 720 standard. Suppose MMS is there in interim financial information, ask the management to amend it. Suppose MMS is there in other information directly. Yes or no? Then additional paragraph in the review report. Put an additional paragraph in review report. Say that other information is materially misstated, or withdraw from the engagement if possible. Yes or no? That's it. Suppose other information not related to. The auditor may identify some MMS in a fact, in information not related to financial matter. So here other information not related to financial matters. Inside that some mistake you identified. That time when discussing apparent misstatement, auditor considered whether there is any difference in judgment, all that. If management refuses, actually that's not relevant, maybe that's not that relevant. Okay, I don't think this is actually one of the advanced concept. Okay, so I don't think in exam they'll ask this level. So this 1 and 2 points are more than sufficient. Okay, other information which is financial, other information which is non-financial, not at all related, but inside that factual misstatement. So misstatements is 3 types: factual misstatement, normal misstatement, like that, some amount related misstatements like that. At 450 standard introduction they'll give. So related to that, communication of matters to management. If a material adjustment is needed, means in the interim financial information, some adjustment is required, modification is required. Communicate it to appropriate level of management. If at all they are not responding, the auditor should inform to top management. Manner of communication, depending upon the sensitivity of the matter, nature of the matter, timing, and documenting oral matters, all that. If top management also does not respond, modify the review report. If at all they are not responding, which is intentional, which is a limitation on the scope, withdraw from the engagement. Sir, you identified fraud and non-compliance with law. Communicate it to the appropriate level of management. See whether collusion is involved, and consider reporting to top management, and also implications in the review report. Review report on interim financials. I think this is not required. Okay, same. I think same 2400. That is enough. Suppose departure from applicable framework for preparation and presentation. If interim financial is prepared but not in accordance with framework, then you will give modified conclusion. The auditor should express a qualified or adverse conclusion if at all a material adjustment is needed in the interim financial, so that it will be in accordance with applicable financial reporting framework. If at all, the modification should describe the nature of the departure. When you are giving a modified conclusion, you should describe in basis for modified conclusion para what is the nature of departure. If necessary, information is omitted. Suppose in the interim financials, some disclosures are not given. That time, auditor has to include the omitted information if possible. Generally, modification is done by adding explanatory paragraph to the review report, and qualifying the conclusion. Generally, we will give basis for qualified conclusion para or adverse conclusion para, like that. Limitation on the scope. So write about limitation of scope in case of a review, like that also they will ask you. If limitation of scope is there, the auditor should not accept the review if at all you are aware of any limitation of the scope. Sir, I accepted the engagement, then the limitation of scope is there, then you need to withdraw from the engagement. Request for removal. First, after accepting, there is a limitation. Request for removal. If management refuses and you cannot complete the review, communicate the reasons in writing. If auditor believes that material adjustment is needed, please communicate it. The auditor consider any legal requirements also, and if required, auditor will give a disclaimer of conclusion if at all if at all there is a limitation after accepting the review engagement. That's it. Then going concern and significant, this is important. Okay, if auditor identifies material uncertainty about entity's ability to contain is going concern and adequate disclosure is made in the interim financials, the auditor modify the report with emphasis of matter paragraph. Test your understanding. Exceptional question at the beginning I already told. Sir, uncertainty, the auditor may have added an EOMP in a prior audit or audit report review. Okay, in the last year, no, there is an MURGC paragraph. I mean, in the last year audit report, MURGC para is there, or in the last year review report, last part review report, some going concern issue is there. If uncertainty is persistent, I mean persist in the current period also uncertainty is there, adequately disclosed in the current period, then in the current period you will give EOMP. Suppose no, if material uncertainty is not adequately disclosed in the current period review, current period interim financials, going concern uncertainty is there but not adequately disclosed, then I will give adverse conclusion or qualified conclusion depending upon the level of severity. Then other considerations, that is not required, documentation, that's not required. That's it. With this 2410 standard is also completed. In this, the most important thing is going concern and significant uncertainties. 4 marks direct question is possible. Please read this carefully. That's it. With this 2400 and 2410 is also completed. That's it. Okay, I hope you thoroughly understood briefly. Now immediately after this, please read it thoroughly. Then CARO 2020. I just want to talk about CARO 2020. You go to my CA Inter Audit Marathon. You just go to my CA Inter Audit Marathon. You just go to my playlist. CA Harsha playlist is there, right? Here you will find something called Go to Revision Sessions. Inside this, my audit marathon will be there. Or you can simply YouTube. Yeah, this one. Okay, you can simply type in the YouTube audit marathon. Mostly mine only will come, you will get on the first. Okay, yeah, audit marathon, you see inside this timestamp will be there. So here I have given CARO explanation approximately for some 40 minutes. I explained. You can put in 2x speed and watch it and then finish. Fantastic it will be. Okay, that's it. CARO 2020. That's it. Review 2400, 2410 both are complete. 2400 review of historical financial information. 2410 review of interim financial information conducted by independent auditor of the performed by independent auditor of the entity. That's it. Perfect. I hope you're all clear now. Yes. Yeah. So let's proceed discussion of 2 important standards, 402 and 3402. Even in the last November exam, every exam you see, many a times a question will come from this particular standards, any of these 2 standards. Okay, sometimes both can also be tested if you are lucky enough. Now 402 and 3402, first pay attention to the heading carefully. 402, audit considerations relating to an entity using service organization. We are conducting audit of an enterprise, an entity, and that entity is using service organization services. At that time, what we need to consider specifically, that is what 402 is talking about. Means 402 is talking about auditor of the user entity. 3402, assurance report on controls at service organization. So this is a different standard. Again, there is a service organization, inside that there are some controls on that assurance report. That is 3402. Now in this particular standard, there are the terms, these are the terms which are very, very confusing for many. I made it in a simplest way to give you a brief idea about what exactly the terms are talking about. Now, before I discuss about this, I want to give you one example here. Suppose my company is a manufacturing company. I am a manufacturing company. For example, we are manufacturing. Best example which I have taken in class, HUL, Hindustan Unilever, which is manufacturing many cosmetics and all. Now, they had a tie-up with Amazon warehouse. Nothing but Amazon e-marketplace, e-commerce operator is there, right? So with them they have a tie-up. Now what is the tie-up? In the Amazon, this HUL will list all their products and all. This Amazon, you know, HUL, Hindustan, this company, nothing but user entity we call. Amazon warehouse is nothing but service organization. Now Hindustan Unilever will maintain majority of their inventory which they manufacture in Amazon warehouse. This company inventory, some 70-80% of the company inventory is completely sold through online directly through Amazon website. Now, you know, every time when Amazon receives an order, no, this company will send goods to Amazon. Amazon will deliver to the customer. Why entire this process? Amazon told one option: we have a warehouse. You please keep all the goods manufactured in this warehouse, so the Hindustan Unilever can reduce warehouse cost. Fine. So Hindustan Unilever, whatever goods that they are manufacturing, they are storing it with Amazon. Inventory lying with third party 501, that standard you can apply here. And not only that, 3402 also, 402 standard can also be applied here. What is 402 says about? Now Hindustan Unilever inventory is lying with Amazon. Now Amazon is maintaining inventory records completely, inflow, outflow, everything, and Amazon warehouse will periodically send Hindustan Unilever stock statements. They will periodically send stock statements. Based on these stock statements, Hindustan Unilever in the balance sheet valuation will be done. That's it. This is the entire, the arrangement between Amazon warehouse and Hindustan Unilever. Suppose now I am doing audit of HUL. Getting it? I'm doing audit of HUL. For me, 402 standard will apply. Now 3402. Now this Amazon warehouse is maintaining inventory records, inventory of various third parties. One of the third parties our client Hindustan Unilever. Now we want to know, as an auditor, we want to know whether Amazon is maintaining proper inventory records, whether Amazon is maintaining proper internal controls on the inventory. We want to know. Now we want to visit the Amazon warehouse. Amazon warehouse is not permitting us. Sir, Amazon warehouse told, sir, like you, there are many other vendors, sir. Now, Hindustan Unilever is there, some other companies there, X companies there, Y companies there. Their auditors also want to visit me. I cannot permit every one of you to visit and check. When will I do business? Amazon warehouse replied that. So, but we want to know, we as an auditors of Hindustan Unilever want to know whether Hindustan Unilever inventory is properly safe or not with the Amazon warehouse. We want to know. For that, what Amazon warehouse did, they appointed one special auditor called service auditor. They appointed an auditor called service auditor. He will give a report. He will give a report called SOC report, systems and organization control report, which is also called as type 1 report and type 2 report. The service auditor will give either type 1 or type 2. Okay, he will give some report, sir. So what report? He will give a report on controls maintained at Amazon. Controls maintained at Amazon warehouse, where these controls will affect various user entities, third parties. So controls maintained at Amazon warehouse, are they proper? Are they designed correctly or not? So whether user entity, financial items and all, whether Amazon is protecting correctly or not, this auditor will verify and then give a report to you. Now user auditor using these reports, getting it, 402 standard will apply. Now service auditor is appointed, right? He should give type 1 report, type 2 report, right? How to give this type 1 report, type 2 report? What service auditor has to do? What is his responsibility? That is covered under 3402 standard. If any of you understand this example, that's it, standard is done. Typically speaking, the standard is done. This example, if you don't understand and read blindly the standard without understanding the background, there is no point of reading that standard. Now that's about the standard. I hope you are able to understand clearly. Fine. Yeah. Now let's look at. Now there are some keywords which are involved in this particular topic, 402 and 3402. There are some keywords. Like, what are the keywords exactly? Just a minute. Yeah, what are the keywords exactly? Control set service organization, because SA 402. Considerations relating to an entity using service organization, audit report on control set service organization. You see, control set service organization, what does it mean? Control set service organization means what? Control description. There is a word called control description, and control objectives and related controls. What is it? Another word, control objectives and related controls. Hindustan Unilever auditor want to know whether controls implemented at Amazon warehouse, are they proper or not? Now for that, what I want to know first, what controls they implemented? That is control description. Why is that control? That is control objective. What exactly they implemented? Related controls. These 2 points will be called as description of system. This is called as what? Description of system. Assurance report he will give, right? Service auditor will give assurance report, right? Assurance report on description of system. Just like description of system is like financial statements. In normal financial statement audit, we will give audit report on financial statements, right? But here we will give assurance report on description of system. Description of system means what? What control they implemented, what are the objectives, what processes exactly implemented. That is called related controls. Now in the standard, they will talk about 2 types of reports, type 1 report and type 2 report. What is type 1 report? Type 1 report is a report on both, by the way, there are 2 types of report, type 1 report and type 2. Both are regarding reasonable assurance only. In both the reports, we will provide reasonable assurance only. Who will provide? 3402, service auditor will give type 1 report, type 2 report. Service auditor will give this report. Okay, what he will give? Service auditor will give reasonable assurance on whether on the description of system, as well as he will give a reasonable assurance on whether controls, like they have given objectives and controls, right? Whether these objectives and controls, are they suitable? What control we implemented, is it suitable for the objective or not? Yeah, so suitability of the controls to meet control objectives, getting it? So we will give a report on description of the system, suitability of the controls to meet control objectives. If at all we are giving report on what description of the system, whether system is described correctly or not, and whether the controls are suitably implemented or not, if at all we are only talking about these two, that at a particular date we are talking about, then that's a type 1 report. Suppose no, we are talking about description of system, we are talking about suitability of controls, we are also talking about operating effectiveness of the control. You see here we are only talking about what system is described, whether it is suitable or not. Suppose we are also talking about operating effectiveness, and where in the report what controls the tested. How do we know whether a control is operating effectively? Service auditor will do testing. Under 3402, whether a control is operating correctly or not, whether a control is operating effectively or not, service auditor will do something called testing. So the testing related information, reporting on operating effectiveness, reporting on test of controls performed, if entire this is covered in a report, then that report is called as type 2 report. This is called SOC2 audit. We also call this as SOC2 audit, where when we are giving type 2 report, no, we don't give report on a specified date. We generally give the report throughout the specified period. Generally type 2 reports are given for throughout the period, whether controls are operating effectively throughout the period. Then you will also talk about test of controls throughout the period. Generally in our EO class and all, we discuss about real reports. We take some reports and then discuss all that. But now this is a revision class before exam, that too we don't have that much time. We have to revise quickly. Okay, that's it. I hope you are able to understand. Now let me directly first discuss 3402, then we'll go to 402. 3402, assurance report on controls at service organization. Okay, what is this assurance report? You know, here Amazon has appointed one separate auditor, service auditor. He may be the statutory auditor, he may not be statutory, that doesn't matter. Okay, Amazon has appointed one service auditor. Now that service auditor has to give a report on controls implemented at Amazon, nothing but controls implemented at service organization, which will affect user entity financial reporting. These controls will affect user entity financial reporting. Suppose if Amazon is not maintaining inventory records correctly, if the controls of inventory are not correctly done, then reporting of inventory details to the user entity will be wrong. If reporting of information is wrong, user entity financial statements might be materially misstated. So that's it. So here, so that's why Amazon appointed one service auditor. Dear service auditor, we implemented controls on inventory belonging to third parties. Whether these controls are operating effectively, whether the controls that we implemented, what controls we implemented, we developed a document. So on that, please give a report. That's what exactly Amazon is asking the service auditor. Now this SCA is applicable. Now this SCA is applies only if service organization is responsible, you know, for making assertion about, okay, it's okay, I think that's applicability is not a big deal. Non-applicability is most important. Non-applicability, what is it? Suppose, no, Amazon appointed one auditor. Sir, we have so many controls in our organization. Please come and report on operating effectiveness of controls. You please come and check our controls and give a report. Where this report is used by Amazon only. Suppose if Amazon, Amazon appointed auditor and the auditor is giving a report on controls, the user is also Amazon only. This standard does not apply. When the standard is applicable, Amazon appointed service auditor, where he will give a report on controls. That report will be forwarded to third parties. We call them as user entities. Then only the standard is applicable, where user auditor has to only report whether service organization controls are operated as described. Whatever controls Amazon described, no, whether are they operated as per the Amazon description or not. If at all, he just have to report on that. Where the report is not given to any user auditors, user entities and all, this standard does not apply. Or where, this standard does not apply, where the user auditor has to report only on controls at service organization unrelated to financial reporting of user entities. Yes. No, where you are giving a report on controls at Amazon, service auditor is appointed, where he is giving a report on Amazon. Okay, Amazon related some controls. These controls are unrelated to user entities. Then also this standard does not apply. Indirectly, when this standard is applicable, when service organization appointed auditor where he is reporting on controls, getting it, where that report is related to user entities, where that report is used by user entities and their auditors. 3402 will apply only when 402 point of view user entity auditor is asking this report. In that context only 3402 engagement will apply. Suppose if a company voluntarily appointed one auditor, service auditor, okay, one auditor. First of all, we will call him a service auditor only when 3402 standard applies. Suppose a company appointed an auditor voluntarily. Sir, please check all our controls in our organization, give a report. Compliance auditor they appointed, for example, where he has to check the controls and then give a report, compliance report. Where we are not giving this report to any third party and all, this standard does not apply. That's it. Very important applicability of the standard. MCQs they might be asking. Now, who is a service organization? Service organization is a third party organization which is providing services to user entity. Amazon warehouse is providing services to Hindustan Unilever. User entity is what? Who is using services of service organization? Hindustan Unilever is maintaining their entire inventory at Amazon warehouse. So Hindustan Unilever is a service organization. Now, why controls at service organization are important? Why controls at service organization? Now, Amazon is implementing so many controls relating to inventory. Why are they important to user entity? Very simple. The controls which are inventory related controls, if these controls are not functional, if they are not functioning properly, or if the controls are not correctly implemented, if the control design is inadequate, suitability is not proper, control is not proper, it will result into reporting of wrong inventory. Reporting of wrong inventory to user entity will affect their financial statements, material misstatement. Yeah. So, impact. Controls at service organization may be relevant to user entity financial reporting, as these controls sometimes may relate to presentation, disclosure and auditing evidence. So, that's it. Here we have given some example called payroll example. You can also see that payroll example. Okay, scope of the controls at service organization under 3402. What is the scope of the control? You know, controls includes controls over user entity information system maintained by service organization. Amazon is maintaining an information system, inventory records, which is relevant to user entity. Yes or no? So that is only included in the scope of control, and other internal control component at service organization related to this. Controls related to description of system of relevant. However, remember, controls of service organization for their own preparation and presentation of financial statements are not relevant in this standard. Even Amazon is preparing financial statements. For that reason, they have some financial controls and all. That is not relevant in the standard. In this standard, which controls are relevant? Service auditor. Which controls are relevant for the service auditor? Those controls which are influencing user entity information system, user entity financial reporting. If that is affected because of the controls of service organization, those controls are relevant for the service auditor. Now ultimately, remember, which control is relevant in the service organization? There are so many controls. Some controls are for their personal purpose, service organization. Some controls are user entity related. Now, which controls are relevant for the service auditor, which is not relevant, is a matter of professional judgment. That's it. User auditor means the auditor who audits and reports on the Hindustan Unilever user entity. Service auditor is a professional accountant. He is a professional accountant in public practice. He is a professional accountant in public practice who, at the request of service organization, provides an assurance report on its control. Service organization requested the auditor to give a report on controls at service organization, and that report is forwarded to user entity. For that reason, we are appointing that auditor is called a service auditor. What is his objective? Very simple. His objective: ensure that service organization system and controls, they are fairly presented. Like verify, you need to verify whether service organization description of its system, service organization prepared one description of system, that system is forwarded to Hindustan Unilever, whether the description of the system is it presenting design and implementation throughout the period or at specified date in a type 1 report. And you need to assess one more responsibility of service auditor. Service auditor has first responsibility whether description of system is fairly representing the actual system implemented. 2, whether the controls related to control objectives, were they suitably designed throughout the specified period? Whether control objectives and the actual controls implemented, are they suitable or not, we need to check. Further, in case of a type 2 report, most of the service organization, they will go for type 2 audit, type 2 report only. They don't go for type 1 report. In reality, you rarely find type 1 report, you only find type 2 generally. Okay, if included, determine whether controls operated effectively to achieve control objectives throughout the period. So every process will have some objective. See, Amazon has implemented so many processes. One process is, for example, only when the goods are actually received and goods are actually delivered, inventory record will be updated. Because of this particular process, inventory record quantity accuracy can be maintained. If quantity accurately is there, automatically financial reporting will be accurate. So this is the control objectives. Getting it? And where service auditor will provide a report based on service auditor's findings in accordance with these objectives. So objectives are 3: verify description of the system, verify whether control objectives are suitably designed, and third one, in case of type 2 report, whether they are operated effectively, and finally you need to provide a report. So accordingly, there are two types of reports, assurance reports. There are two types of assurance reports which a service auditor will provide: type 1 report, type 2 report. Type 1 report is what? First of all, service organization description. First of all, there is a description of system. There is a document which talks about what exactly the system implemented, and a written assertion by service organization. Service organization will give written representation in the description. What written representation? They will say that description is presenting the real system implemented and controls are suitably designed at a specified date. Service organization is giving one document inside that what controls they implemented, what controls they have designed, what controls they have implemented, whether they're suitable or not. They're giving all those descriptions. Getting it? And we, service auditor, now what service audit, what is type 1 report? Type 1 report is service auditor report. This is actually type 1 report, this is type 2 report. This is about the report. Okay, what is type 1 report? Type 1 report is a service auditor's assurance report about reasonable assurance about matters covered in. So I will read service organization management description letter document, all that. Whatever I read, no, is it real or not, I will verify, and then I will give a type 1 report. Now, whereas in a type 2 report, no, service organization management, no, they will also mention that they will they will assert that controls are operating effectively throughout the period. So service organization management is saying controls are operating effectively. I need to give a report on the description. So for that, what I will do, I will give reasonable assurance, and I will also do test of controls in order to know whether controls are operating effectively or not. So accordingly, type 2 report will contain description. One more paragraph in the type 2 audit report. In type 2, we will give assurance report, right? Let's use the word assurance report. We will give a type 2 assurance report, right? In that report, we will have one more para. The test of controls performed and results thereof. Like that, one more paragraph will be there. Okay, then how do I proceed with this engagement? But before I go into that, let me directly tell you about modified opinion. When service auditor will give a modified opinion, directly they can ask you this as a 4 marks question. Okay, service auditor will give modified opinion if he concluded that description is not fairly, like what Amazon in reality, what controls they implemented and what they are showing in the description document, they're not matching. Controls were not suitably designed. They designed some controls, but they're not suitable for the objectives, or controls are not operating. If controls are not operating effectively and I'm supposed to give a type 2 report, then also I will give a modified opinion. Or I am unable to obtain sufficient appropriate audit evidence. If service auditor is unable to obtain evidence, then also we will give modified opinion. Then the service auditor opinion shall be modified and assurance report must clearly explain the reasons. Further, service auditor has to document. He must prepare documentation where an experienced auditor can understand how you planned the work, what is the result, and significant matters. Experienced auditor should understand all these three. In such a way, service auditor should document. So straight away, this can be asked as a 4 marks question. Documentation can be asked as a 3 marks question. Next, and I told you, this itself can be asked as a straight question for 4 marks. Write about additional reporting requirements in case of type 2 report. Generally in a type 2 report, no, there will be another section, separate section on control testing. In type 2 report, title will be there, address will be there, identification of controls, so much will be there, opinion section will be there. Apart from that, there will be another separate side heading. Okay, that side heading will be test of controls performed and the results. Here you need to clearly state which controls tested, whether testing is on a sample basis 100%, what kind of testing you did, and you should also report deviations. If deviations are identified, specify the sample size and what deviations exactly, describe that. Even if the control objectives are achieved, sometimes no deviations will be there. What control they implemented, that control might not be working effectively, some deviation might be there, but because of this there is no MMS, because of this there is no fraud, because of this there is no error. Even if there is no error or fraud, control is deviated, right? Control is not operating effectively, right? That has to be reported. That's it. So these are the additional reporting requirements, which itself can be asked as a straight question. Then this is regarding service auditors assurance report. This is not a big deal, so this is not required, it's okay. I think in this there is nothing important. By the way, date of service auditor report, it must not be earlier than the date when service auditor has obtained sufficient appropriate evidence. That's okay, that's a normal thing, it's okay, no issue. So that is not important. Further, representation point, most important, straight away 4 marks question. When a service auditor is conducting, when a service auditor is providing assurance on controls at service organization, in the process of that work, service auditor should obtain some written representations. What are they? Obtain written representations from a service organization stating, reaffirm the assertion regarding description of the system. The described system, no, get once again a representation that the system description is correct or not. Further, you should get a representation that all relevant information is given to you. Further, you need to get a representation that management has disclosed the service auditor. Service auditor is asking declaration from company. Dear company, give a declaration that you showed everything to me. What exactly? Non-compliances, frauds, deviations, which will impact user entity, because my report is being used by user entity. So you have a responsibility to show me what are all non-compliances you did. Design deficiencies in controls which management is aware of. Instances where control fail, where and all control fail, when and all control fail. They will have a list of control failures, exceptions reports that they need to disclose. Subsequent events that could impact assurance report. For all of this, I must specifically obtain written representation from management of service organization. This is important question. Then, now, acceptance and changes in terms of engagement. This is most important, another important question in this particular standard. So how can I proceed with this engagement? First, service auditor, whenever a company requested you, a service organization requested you to act as a service auditor, immediately you should not accept blindly. SQC says you should check competence and capability. That's what once again here they highlighted. The service auditor must ensure capability and competence before accepting. Verify criteria used to describe the system. Some COSO framework, COCO framework, COBIT framework, some framework company will use for controls related description preparation. Okay, so whether the criteria followed by the management of service organization to prepare description of system, is it suitable and available for user entities and user auditors? Check out and see that the engagement scope and system description of useful, like service organization is appointing me to do audit of some controls, right? Whether these controls are relevant to user entities, check out. If service organization requests a scope change, suppose now after you were appointed, they are asking you to change the scope, see whether it is reasonably justification is there or not. So very important. So criteria, it's okay, I think that is enough. That's enough. Okay, so these 2 points are important. That's it. 3402 standard is completely done. That's it, very simple. The standard is very simple. I don't know how many of you thought it's so complex, so much is there. No, it's very simple. Now having understood 3402, now we'll go back to 402 standard. Okay, 402. Now 402 is a little more complex compared to 3402. Now look at this 402. Just 1 minute. I hope you're now you got now little clarity on what exactly 3402 is about. Just comment, just give your comments. I'll be happy to see whether you're understanding properly or not. Whatever questions I'm touching, wherever I'm saying that this can be asked as a 4 marks question or 3 marks question, 2 marks question, if you're studying that confidently, if you're revising that confidently, sufficient. Very tough standards actually. 402 content is simple. But the terminology used is very tough in the standard. 402, audit considerations relating to an entity using service organization. Fine. So now I am the auditor of HUL. I want to ask, Amazon, dear Amazon, our HUL inventory so much is there with you. I want to come and physically verify. For that, Amazon told me, sir, you can't come physically, sir. We have so many third parties like you. If everybody comes physically, how Amazon will do business? Fine. That their concern is right. But I want to know, as a HUL auditor, my inventory is there with the Amazon. Whether the inventory is maintained in a proper good condition, existence and condition proper or not, whether quantities maintained properly, because records are maintained by them. I want to know whether they're maintained properly. For that, what Amazon told, sir, don't worry, we will give you type 1 report, type 2 report. What is type 1 report, type 2 report? Sir, don't worry, you are the HUL auditor, right? You want to know whether our inventory records are maintained correctly, whether your inventory records are maintained correctly here or not, you want to know, right? For that, we appointed one auditor, sir. He already gave a report on whether we are maintaining reports correctly or not. I will forward that report to you. The service organization is forwarding me type 1 or type 2 report. Now, in this context, what is my responsibility exactly? What are all I need to consider? That's what 402 standard is talking about. Now, if you see in this diagram, description of system, you see description of system, it includes complementary user entity controls. There is something called complementary user entity controls. What is complementary user entity controls? See, whenever our company, Hindustan Unilever, whenever we are outsourcing some work to them, we also have to maintain some records, right? Regarding whatever we are outsourcing there, some incidental records and all we need to maintain. So for that, we need to implement some controls, right? These controls are called as complementary user entity controls. Complementary user entity controls are controls implemented by user entity, which is assumed by service organization things we implemented, and accordingly they will plan their services. Sometimes they are correct, but if user entity controls, complementary user entity controls, if they are not implemented effectively, misstatement will happen in financial statements because of our client only. Now you need to check, you need to know, I mean, sometimes 315 standard says we have to verify operating effectiveness of our controls as well as service organization controls. That time complementary user entity controls, are they operating effectively or not, also we have to know. Next, fine, I'll come back to it. Now tell me, services provided by service organization, are they relevant to user entity financials? Yes, they are relevant. When they're relevant, a service organization services affect user entity financial reporting if they impact any of the following. If at all Amazon is providing me services, right? Some services they are providing to HUL, right? If at all those services impact some transactions in the HUL, getting it, or if they're impacting procedures where accounting is affected, or if they are impacting accounting records, or if they're impacting events and conditions related to financial statements, or they're impacting financial reporting process, or they're impacting journal entries, non-recurring entries, unusual entries, in all these cases service organization services are deemed to be relevant to user entity user auditor. Straight away a 4 marks question. What are the factors the auditor has to consider to identify whether service organization services affect user entity financial reporting? Service organization services, they are affecting user entity financial reporting. Then only those services I am bothered as a user auditor. That's it. So objectives of the user auditor. Here, types of service auditor report, exactly I already spoke. Type 2 report, type 1 report. Type 1 report is what? It's a report by service auditor where he is providing reasonable assurance including opinion on description of the system, objectives and related controls, suitability on a specified date. Whereas in a type 2 report, it's a report by service auditor giving reasonable assurance on opinion on the description of system, control objectives, suitability, operating effectiveness. Not only that, in a type 2 report additionally operating effectiveness will be there as well as E point. Okay, description of service auditor's test of controls and results will also be there. So in a type 2 report, what test of controls he performed, that will also be mentioned. Then understanding of the services, this was asked in November 24 exam already, but don't think, many of you will think since November 24 it asked, it will not be asked once again. There is no guarantee like that. Okay, so understanding of the services provided by service organization. So as a user auditor, I must understand what kind of services they are providing to me. First, what is the nature of services? Are Hindustan Unilever inventory is maintained in the Amazon warehouse, that inventory physically they are maintaining, records also they are maintaining. So understand the nature of service, understand nature of services. services and what is their significance to the user entity, what is their effect on the user entity controls. And this you can get an understanding from this information, you can get from user manuals, service organization and user entity will have some contract, all that. Okay, materiality. Also understand, second thing that you should understand is materiality with the transactions processed. Our client Hindustan Unilever inventory balance sheet, 40% of the balance sheet asset total value is inventory. Inside this inventory 90% of the inventory is with the third party. So what is the materiality of the transaction processed by service organization? If the transactions are immaterial, yes or no, they might still be significant due to the nature. Okay, fine. This point is not required from exam point of view. This first point is enough. And then second factor, first understand the nature of services service organization is providing. 2, materiality of the transactions affected by services provided by service organization. 3, degree of interaction. Understand the degree of interaction between the user entity and service auditor. Generally, how this refers to how much control the user entity has over service organization processing, how far we are influencing, how far they are influencing. Relationship. Also understand, is there any relationship between HUL and Amazon warehouse? Are they related parties? Identify. Understand the relationship between user entity and a service organization. Like look at the contractual terms and conditions, look at what services they are providing, see whether there is a huge dependence or not. Try to identify any related party relationship is there or not. If related parties, no, 550 standard also will apply. Next, then see, obtaining an understanding of internal control relevant to audit. Generally, whenever we are doing audit, no, whatever internal control relevant to audit, we must obtain understanding. This is what mentioned in 315 standard. Yes or no? So the user auditor evaluate, design and implementation of relevant controls at user entities. So that is our responsibility. But some transactions are processed by service organization. Related to that, controls are also maintained at service organization. Therefore, I need to understand controls at service organization. Since I want to understand controls at service organization, I am taking type 1 and type 2 report. Simple as such. Okay, so the user auditor get a sufficient understanding of nature and significance of services provided by service organization and what is their effect on the user entity internal control. What exactly the nature of service provided by them, what is their impact on the user entity internal control, get an understanding. Sometimes we are unable to obtain understanding from the user entity. When I'm interacting with user entity, they are unable to explain me clearly what exactly they're doing. In such a case, I will directly ask type 1 type 2 report, obtain type 1 type 2 report. Suppose type 1 type 2 report service organization does not prepare or they're not sending me, then I will contact organization through the user entity to obtain necessary information. If at all still I'm not getting information, then I will visit the service organization, and perform procedures to gather necessary, or I will send another auditor to provide necessary information. I will use another auditor and send him there, ask him to get the entire information and then send it back to me. So this itself can be asked as a 4 marks question. Wherever I'm telling marks can be asked, that only is important. This itself can be unable. If user auditor cannot obtain sufficient understanding from user entity regarding services provided by service organization, then user auditor can request type 1 type 2 report. If type 1 type 2 report is not there, contact the service organization. If they're not responding, visit the service organization. If you don't have time to visit, or if it is difficult for you to visit, it is there at a very remote location, arrange another auditor there to visit service organization. Any of this can be done. Then okay sir, type 1 type 2 report they gave, sir. Type 1 and type 2 reports by user auditor of user entity using type 1 report or type 2 report. So when you're getting type 1, no, first before start reading it, type 1 report, type 2 report is given by service auditor, right? Who is he? Is he a chartered accountant like you? Is he also competent professionally? The service auditor's competence checkout. What is his independence checkout? Is this guy independent from the service organization? Amazon appointed service auditor. What is the relationship between them? If they're unrelated to each other, then that report I will trust. Adequacy of standards. Service auditor gave type 1 type 2 report, right? By following which standards he conducted that work, check out. He also followed 3402, then happy, you will trust it. And if auditor is decided, okay fine, I first decided service auditor's professional competence, independence, capability, competence, standards, all that. I felt he is very genuine. Now I decided to use his report. Then I will evaluate whether description and design of controls is as at a particular date or is it for a particular period. Is it relevant for the audit? Okay. So now service audit report is there. Amazon has given type 1 type 2 report. I am doing audit for 24-25 financial year. Amazon he has given type 1 type 2 report of 21-22 3 years back report. That is not relevant for me. So evaluate whether description and design of controls is for a date or period, whatever the date, for whatever the period type 1 type 2 report is given, no, is it appropriate for our audit checkout? Okay, there is a in 315 there is a requirement, once in 3 years we have to do an ad hoc complete review of internal control system. It's already more than 3 years. Type 1 type 2 reports were older than 3 years, may not be useful for me. Next, assess sufficiency, appropriateness of evidence provided by the report, all that. Then complementary user entity controls, no, suppose, no, I'm the auditor of HCL, no, I identified complementary user entity controls. If that is the case, you need to check whether user entity has designed and implemented complementary user entity controls. What is a complementary user entity controls? This itself can be asked as a 3 marks question. These are the controls which service organization assumes. Service organization assumes. What they assume? They assume that we implemented. Okay, that will be implemented by user entity to achieve control objectives, and they are identified by the service organization description of the system. Fine. Finally, responding to the assessed risk of MMS in relation to services provided by service. Whether check if sufficient appropriate evidence is available from the record centered user entity. If not, perform additional procedure to obtain necessary information. If user auditors risk assessment expect that controls a service organization is operating effectively, actually this is not that required. It's okay. This is bit tough. If at all those of you have not studied, leave it. It's okay. No problem. Using a type 2 report as auditors. This was also asked many times, a 4 marks question. When user auditor decided to use type 2 audit report, type 2 report as an auditor, what extra points you should consider? Assess whether description of the system, design of the system, operating effectiveness of, is it for a particular date or is it for a particular period appropriate for the audit. In type 1 also we have seen similar point. So type 2 report they have given, no, when the type 2 report is prepared, for what period it was addressing, is that period, is that date relevant for my audit? Suppose if the type 2 report is very old report, I may not use it. Next, complementary. The user auditor must determine whether complementary user entity controls are identified by service organization. Are they relevant? If so, understand whether user entity has designed and implemented the control. If required, test the operating effectiveness. So when you are using type 2 reports, these are the type 2 report talks about controls implemented by service organization at service organization. Now in the description document, no, complementary user entity controls also they spoke about. Oh, our client also has to implement some controls relating to this outsourcing activity. Whether these controls are operating effectively or not also you should check. So when you're using a type 2 report, first to look at when that report is belonging to. Is that report appropriate for my audit, relevant for my audit? 2, if complementary user entity controls are also there, see whether they are operating effectively or not. And the user auditor must evaluate the time period covered by test of controls and time lapsed since the last testing. This type 2 report talks about some test of controls where when they tested long ago, see whether the test can be relied or not. And the user auditor must assess whether test of controls performed by service auditor and the results are they relevant to the assertions in the user auditor financials. So by the way, I'm talking about inventory. So and the service auditor has also performed some test of controls on inventory. Are they relevant or not? Check out. Then suppose, no, you identified, okay, so user auditor, no, I will ask our management, I will ask our client HUL, dear HUL, did service organization reported you any material misstatement in inventory records, any non-compliance with loss, any uncorrected misstatements, any frauds? Remember, a similar thing, service auditor also will get a written representation from service organization that any frauds, non-compliances, MMS, all that. Yes or no? Here user auditor will ask user organization, user auditor will ask user entity, dear user entity, did service organization intimated you any frauds, any non-compliances, any material misstatement? Please give me. And the user auditor must assess how such matters affect nature, timing of further audit procedure. Finally, this is very important. Regarding this, one exceptional question is there. In your ICI, test your knowledge question number 13 is added. Inside this, what happened, the type 2 report was provided by service organization, which was based on carve-out method. That method and all irrelevant, okay? Akram, while reviewing unmodified report, or you see this one, unmodified report drafted by his assistant, found that a reference has been made to the work by service auditor. Oh, we are the user auditor, right? We are giving audit, we are giving opinion on Fab Limited. We are the auditors of Fab Limited. On Fab Limited, our audit firm decided to give unmodified opinion, and assistant already prepared the audit report with unmodified opinion. Inside that, service auditor name is given. not permitted. You see now, suppose after doing all this, in this context, in which context? Services of service organization our client is using, on inventory related thing. On inventory, we decided unmodified opinion is required, enough. We decided to give a positive opinion, unmodified opinion. In such a case, in audit report, can I talk about service auditor, service organization, all that? No, prohibited. The user auditor should not refer to the work of service auditor if audit report is unmodified unless mandatory in law. If required, the report must clarify. Suppose, sir, law says it is mandatory, sir. That's why we are reporting, sir. If at all you are talking about service auditor, your report clearly state that reference will not reduce user auditor responsibility. Just because I'm talking about service auditor, that doesn't mean my responsibility is reduced. Ultimately, inventory related controls are operating effectively or not is my responsibility only. Next, suppose after using type 2 report, I got to know that inventory records are materially misstated. To that extent, financial statements are materially misstated on inventory. I requested management to rectify inventory valuation. They did not. So I decided to give modified opinion on inventory. Now I have to explain in basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion. Why I gave a modified opinion? I have to give reasons. No. To make the people understand the reason behind my modification, I can refer about type 1, type 2 report, service audit report, all that. Again, just because you are referring in basis for modified opinion section regarding service audit report, that does not reduce your responsibility. That fact you should mention. The user auditor must modify the opinion according to 705. If they cannot obtain sufficient appropriate evidence about services provided by service, or you are unable to obtain evidence, then you will modify. 2. If reference to service auditor work is relevant for modification, please clarify that reference does not reduce auditor's responsibility. 1. When you are unable to obtain evidence, you give modified opinion, or you got an evidence and concluded material mistake, that time also you'll give modified opinion. If reference to service auditor work is relevant, see, you want to tell the people why you modified. I modified because service audit report I could not obtain, or service audit report I obtained, I found a material misstatement based on their report. I want to tell the reason. For explaining reason purpose, you can refer about the service auditor's name, and such a reference will not reduce the user auditor responsibility. Now in this case, on Fab Limited, the auditor is there. Who is the auditor here? Akrama something, yeah, CA Akram. While reviewing unmodified report which is drafted by the assistant, found that a reference has been made. Are you are saying unmodified audit report, reference is given to service auditor, all that is not correct. Here you see, in the view of the above, contention of Akram in removing reference to work done by service auditor in order, because it's an unmodified, cannot refer to be, yeah, correct. So that is proper. Yes or no? Is in order. In order means what? It's proper. That's what they mean to say. So the user auditor shall not refer to work of service auditor in the user auditor's report containing unmodified opinion unless required by law. If at all such a reference is required by law, user auditor shall indicate that reference will not reduce the responsibility of the user auditor. That's it. 402-3402 is completed. 45 minutes it took. It's okay. Fine. I covered decently at least. That's it. This is a newly added question here. Carve out method and all that wordings and all used. Don't get tense, leave it. Okay, this is regarding reference in the audit report only. This reference in audit report is exactly similar to SA 620 standard. In SA 620, using the work of auditor's expert, can an auditor refer about auditor's expert name in the auditor's report? No need in case of unmodified opinion. But if you are giving modified opinion based on his findings, to tell the people why you give a modified opinion, you can refer about his name. That's it. Are you clear? Ultimately, remember, you are only responsible to obtain. You are only responsible for obtaining evidence on controls at service organization, operating effectiveness. Everything is your responsibility, primary responsibility. Okay, but since you are unable to verify that, you are taking type 1, type 2 report. You are using it and then concluding. That's it. Clear? Yeah. So with this, 402-3402 is completed. That's it. I hope you thoroughly enjoyed. Please give your comments if at all you thoroughly enjoy. I mean, you thoroughly understood. I understand. I finished very fast because exam here, getting it. So I tried my level best to bring you some clarity on 402-3402, such a very complex topic. That's it. Yeah. Thank you. So let's begin the standards on related services, which is 4000 series. A simplest chapter. This is 9th chapter in your ICA book, which is a simplest chapter, and easily you can secure minimum 2 marks MCQ will be there, or a 4 or 5 marks descriptive question also might be there. Such a simplest chapter, guys. Related services, like we all know, even if you have seen, if you have observed my reporting topic, there itself I clearly told that the various services that we provide are broadly two types. We chartered accountants provide two types of broad services. One is assurance engagement, non-assurance engagement. If at all the service that we are providing does not involve any assurance or third party, in the sense there is no degree of confidence given to third party, then that services are called as related services, and for them standards on related services do apply. Standards on related services apply. Now, first of all, there are two standards in this particular topic. One is 4400, 4410. Two topics were there. One is 4400. You see the 4400 standard, agreed upon procedures. Engagement, you are engaged to perform an agreed upon procedure regarding financial information. Remember, guys, though they said financial information, within the standard they also told that if at all you are agreed upon, if at all you are accepting any agreed upon procedure for non-financial information also, that is also permitted. For example, a company is preparing business responsibility and sustainability report. In that particular, some information the company asked you to either compile. For example, 4410 is there. What is this 4410 is talking about? Compilation engagement, compilation of financial information, or even it can be applied for non-financial information as well. No problem at all. So 4410, agreed upon procedure for financial, compilation engagement for financial. For example, one of the example of non-financial information is business responsibility and sustainability reporting. Inside that, the many companies have to give some disclosures, some leadership disclosures, essential disclosures, something they need to give. So if at all you are assisting the company in performing certain procedures regarding those items or compiling those items, then also these standards can be applied. Fine. What is a popular agreed upon procedures that we really find? For example, a bank called you exclusively for conducting stock audit on behalf of the bank, okay, as an internal assignment. That might come under agreed upon procedure, stock audit, where you just have to go to a borrower place and then verify the physical stock and then report to the banker whatever the physical stock that you found. No assurance, nothing. You just have to perform the procedures which you agreed with the banker. That's it. Nothing much work. No assurance is given. You're not giving any opinion, all that. Now, so related services. Related services means what? These are all something which are not an assurance engagements. Like tax return preparation services, consulting services, all that. So these standards on related services like agreed upon and compilation deals with. What is an agreed upon procedure? In an agreed upon procedure, auditor is engaged on a fact finding job, or a specific procedure will be performed on the subject matter, either in respect of a specific element of the financial, account of the financial, item of the financial. What is the role of the practice? No, you need not be auditor of the entity where you are providing related service. No, you need not be auditor. Remember, by the way, I can be an auditor of the company also, and I can also provide related services. Often many students have confusion. Sir, an auditor of a company cannot provide related services. So you can provide. Yeah, in professional ethics you have seen management, consultancy and other services. Many of that will come under related services only. Maybe agreed upon procedure standard might apply, might not apply. That's it. Now let's begin the first and foremost standard 4400, engagements to perform agreed upon procedures. Engagements to perform agreed upon procedures on financial information. Without first I discuss the actual standard, let me discuss let me discuss about reporting on agreed upon procedure. Like, how do we give a report on agreed upon procedure? Generally there will be a title, just like I have showed in 800 series and 700 series. Here also there will be a title to the agreed upon procedure report. We will mention report on agreed upon procedures performed by so and so practitioner. Like that you may give a heading. If you want 4400, actually in the regular class, all that I show, all that reports, we discuss those reports in from ICU illustrations, all that. But since it's a marathon, it's not possible to cover all that. I request you to once go to ICI website 4400. You can simply Google it. 4400 standard PDF you can download. You can Google it. In that standard last you will find illustration on that. So title will be there, address whoever have appointed you, and especially you need to make certain statements in the report. You need to make certain statements. What are the statements, most important statements? You need to make a statement that procedures are not an audit, procedures performed are not a review, so no assurance is provided. Specifically in the agreed upon procedure report, you specifically have to tell this is not an audit, this is not a review, and no assurance is provided. Further, you must make a statement that if at all additional procedures like audit and review performed, it might reveal some other matters. Getting it? So in an agreed upon procedure on financial information, you don't have to obtain evidence whether the financial information is right or wrong. You don't have to obtain any evidence. Whereas even in compilation engagement also, suppose compilation means what, 4410 standard, 4410. What compilation standard says, a company specifically calls you to prepare balance sheet P&L as per schedule 3, division 1, division 2, division 3, because they don't have that many internal resources, they're not familiar with schedule 3, all that, so they called you and you went to the company and you prepared balance sheet P&L based on the trial balance given by them. You don't have to verify whether trial balance is right or wrong. Remember, you are here to assist them. You are using your financial reporting expertise and assist them in preparing the financial statements. That's it. You don't have to verify accuracy of the trial balance. However, if you came to know in the process of compilation that the information given is apparently wrong, then you should tell the management, please change it. Knowingly don't compile information based on wrong data. That doesn't mean whether the data is right or wrong, you don't have to obtain any evidence. Simple. So you need to make these statements. Further, you need to make a statement that report is purely restricted to those with whom you agreed procedure. You need to clearly make a statement that engagement is conducted as per related services. You need to clearly make a statement that procedures were agreed with the recipient, and you need to clearly mention that it's only a fact finding report, including errors, including exceptions, all that. And you should also list out what are the procedures that you exactly performed. Briefly you can list out. And finally, date of the report and place of signature and documentation. And remember, auditor must and should document, which are important for evidence that an engagement was carried out as per SRS, since it does not involve any assurance. Sorry. Since it does not involve assurance, you can't escape saying there is no assurance involved. Why documentation? No, documentation is must. If you perform an agreed upon procedure or compilation engagement, wherever you do, whatever you do, documentation is compulsory. That's it. So this is the report of agreed upon procedure. Now, what is the ethical requirement? General principles of agreed upon procedure. What is it? Very simple. You must comply with code of ethics. Any work you accept, relevant ethical requirements you should satisfy. Remember, there is a standard SQC which says that auditor has to accept, auditor while accepting and continuing a client relationship and specific engagement, relevant ethical requirements. So in every engagement, one of the ethical requirement is what? You need to check your competence. Without knowing your competence, without you being competent, you should not accept that work. But of course, this is a non-assurance engagement, right? Independence may not be mandatory. You see here, independence may not be, just a minute, independence may not be mandatory. So an however, client may request you, the person, third party who is asking, for example, he might request you to be independent also. If at all the auditor is not independent, in the report you must specifically mention the statement. And what are the fundamental principles? Integrity, objectivity, competence, due care, conduct, professional conduct, technical standards, all this. That's it. Straight away they may ask you a question on this. Straight away, a 5 marks question, straight away, or 4 marks question. And I told you, right, they will ask you a statement. Agreed upon procedure has been completed by you, and you have to give a report. There are certain statements which auditor has to give as a disclaimer or give in the agreed upon procedure report. What are those statements? 5 marks. So like this they may ask you. Finally, so what is the difference between audit and agreed upon procedure? Straight away a 4 marks question might be possible. Straight away a 4 marks question might be possible. So what is the difference between audit? Audit means opinion. Okay, it involves assurance. Whereas in agreed upon procedure, we only report factual findings. Like we do something, whatever we find, we report. We go for stock audit, we'll do physical verification. How much as per record, how much as per physical is there, whether statement filed by the borrower to the banker, quarterly stock statement, whether that stock is physically there or not. We just go find out and report it. Factual finding job. That's it. No assurance is given. Users draw their own conclusions. Agreed upon procedures are considered as non-assurance. And give examples. compare names of major suppliers and amounts. For example, no, accounts payable related agreed upon procedure, like you need to compare supplier's name and trial balance, get a confirmation from them, compare amounts in the trial balance, report actual findings, do reconciliation. That's it. This is an example with respect to trade payables. That's it. So in exam they'll ask you this itself, straight away 4 marks question. Very simple. Then what is the objective of the auditor in this? Very simple. The auditor does not provide any assurance. User assess the procedures and findings to draw their own conclusions. Auditor will do some procedures and he'll just give findings. Restricted. This is restricted to those who agree to the procedures. Others and all may misinterpret. Whenever the report is restricted, you should clearly tell that this is not useful for others. This is only for the recipient purpose. That's it. Just 1 or 2 more. Terms of engagement. Obviously, just like audit, just like review, just like any other engagement, we must establish terms of engagement in order to avoid confusion. Auditor has to ensure that the representative of the client understand the agreed upon procedures and conditions of the engagement. An engagement letter is important to avoid misunderstanding, where you need to clearly set objective, scope, auditor responsibilities. By the way, in this standard, just because the word auditor is used, that doesn't mean audit. We are basically referred as what? Auditors, practitioners, professional accountants. We are basically referred as such. So no problem at all. And what are the engagement letter should clearly include what are the list of procedures that we agreed upon, and a statement that description of the report will be restricted only to agreed parties. In the engagement letter itself, I should tell management, you should not give this report to outsiders. That's why you see agreed upon procedure report will below big bold capital letters confidential. That wordings will be there. And next, matters to be agreed. What is the nature of the engagement? For example, stock audit. Purpose of the engagement to verify whether borrower filed statements, borrower stock statements are matching or not. Identification of the financial information to which inventory in hand, inventory in go down. For example, what are the specific procedures? Auditor has to physically visit and do all that. Limitations and distributions. The auditor cannot verify third party premises. Suppose the company has a inventory with third party. Okay, so that's one of the limitation when verifying physical inventory. If limitation is if at all the limitation is something like legally conflicting, do not accept the engagement. And finally, plan and perform the procedure. Obviously, any engagement that we perform, if it has to be effective, it has to be planned. You should plan the work. Execution planning, we call this as what? Execution planning. Only then your engagement will be effective. So what are the procedures that we do in audit? What procedures we do? Inquiry, inspection, observation, confirmation, recalculation, reperformance, analytical. Same here also. Inquiry, recommendation, observation, inspection, obtaining confirmations. That's it. The auditor shall carry out agreed upon procedures and use the evidence to obtain a report of factual findings. Over the standard. That's it. 4400, hardly 13 minutes. I hope you understood. Getting it? So look at objective. What is the difference between audit and agreed upon? What are the general principles, ethical requirements, independence regarding terms of engagement? And then they discussed about matters to be agreed. Straight away, this itself can be asked as a 3 marks or 4 marks question. And finally, planning and performing the procedures. Agreed upon procedures must be planned so that an effective work can be done. And you can perform the following procedures, which includes finally reporting. So identification of the information, financial or non-financial. I told you, even though the standard heading is financial information, you can also perform agreed upon on non-financial information. Inventory audit is a non-financial. Best example. That's it. 4400 is completed. Now let's discuss about 4410, compilation engagement. Compilation means what? Preparing. Exactly, in the context of related services, what is compilation? Compilation of financial information as per applicable financial reporting framework, which may be general purpose framework, which may be special purpose framework. A company has to prepare financial statements which may be a special purpose or which may be special general purpose. They want to prepare restated financials, or they may want to prepare summary financials, or they may want to prepare single financial. Whatever it is, they want to prepare, but they are not competent. So they approached you because you are competent, right? So they approached you. So now they are asking you, sir, can you please help us to prepare financial statements, because you are a financial reporting expertise. No, they don't know that you only studied important questions. It's okay, I'm just joking. Okay, fine. So they are thinking that you are an expert in financial reporting, so they're asking your assistance. So that's a compilation. I'm sorry. What is a compilation engagement? Practitioner uses his accounting expertise, financial reporting expertise to aid, nothing but to assist management in preparing, presenting financial information and issuing a report. You better use the word assist. Okay, and management generally may ask professional accountant to assist preparation and presentation of financials. Remember, you are only assisting them in preparing financials as per schedule 3. This is not an assurance engagement. You do not verify accuracy and completeness of the information given to you so that you prepare. So they gave a trial balance. You don't have to check whether it is true and fair or not, whether the information is correct. That is not your business. They gave you trial balance, compile balance sheet and P&L as per schedule 3 format and give them back. That's it. Then what is the purpose generally? Why compilation engagement clients may approach you? Because they have to prepare annually the financial statements, mandatory periodical reporting, or internal purpose, or for transactional purpose, some special purpose financials they need to prepare, and they did not find any auditor, so they found you, and external reporting purpose. For these purposes generally compilation of financial statements will be done and the management will approach you. And remember, most important SQC is obviously applicable. Since 4410 is also an engagement as per engagement and quality control framework, SQC will obviously apply. So here it applies to compilation of historical financial information, compilation engagement for non-historical as well as non-financial information can also be performed. This standard can be used with necessary adaptation. For example, a business responsibility sustainability report. A company is preparing business responsibility sustainability report. They are not that much familiar with what are exactly how to prepare that. You know it very well, so you can assist them in preparing business responsibility. That is not a financial statement. That is not a historical financial information. That is not a financial information at all. Okay, still this standard can be applied there. The principles of the standard can be applied there. And next no, before I discuss all this, first let me talk about the report. Always first we will see the report. You know, reporting requirement is most important. If you understand reporting requirement correctly, the remaining content is dead easy. Title, addressee, which is based on the terms of engagement, and you must provide a statement that practitioner has compiled financial information, balance sheet, P&L based on information provided by the management. You must clearly mention this statement, and you must clearly mention a description of what are responsibilities. In a compilation, what is the responsibility? They need to give you the data. They need to give you reliable, correct, accurate, complete data. That is their responsibility. And explanation that since it is not an assurance engagement, we are not required to verify accuracy and completeness. This is most important. You know, this is called as caveats. These are called as what? Caveats. What are the important caveats which auditor has to mention in a compilation report? You need to mention the most important caveat. Since this is not an assurance engagement, auditor is not required to verify accuracy and completeness of information, and practitioner does not express any opinion or a review. We don't either audit, we neither audit nor review. We clearly mention that. Further, if at all you are doing a compilation of special purpose financials, you should also clearly describe the purpose and who are the users for whose purpose this compilation report is given, and alert the readers that financial information may not be suitable for others. For alert to know, you can use always emphasis of matter paragraph for alerting the users. And practitioner report, practitioner signature, and of course you will clearly mention what are your responsibilities, and you will also state that engagement was performed as per SRS. You know, they may ask you a straight question. Practitioner's report is final outcome of a compilation engagement. What are the few important caveats or important statements which a practitioner has to make in a compilation report? They may ask you this. Getting it? They may ask you this. So the statement that you have compiled financial information based on management provided data, a statement about management responsibilities, identification of the framework applicable, if at all a special purpose framework reference shall be given, identification of financial title, all that, and description of their description of your responsibilities, and a statement that you have complied with SRS, and explanation that this is not an assurance, it does not involve audit, does not involve review, so we don't have to verify accuracy of the information. But remember, most important point, many students which they don't understand is propose amendments here. A 3 marks or 4 marks question, they may ask you in exam straight away. You see, in our book it is performing the compilation engagement. Okay, fine, you understood what is compilation, you understood how to give a report on compilation, how to perform this engagement. Very simple. First understand the matter, which financial statements they're asking me, understand, look at the entity business, look at the accounting system and records, look at the financial reporting framework, is it a general purpose or special purpose? So understand the context, then only you can assist the management in the right way, then only you can tell what is the right accounting policy, then only you can tell them what is the right accounting estimate, all that. So without understanding business and all, you can't do a compilation engagement. Now compile the information. How to compile the financial information? 4 marks question they may ask you. Compile information using records, documents, explanations provided by management. Any significant judgments, assumptions, accounting estimates were there? No. Discuss with management and top management. Review compiled information in light of entities, business and applicable framework. Whatever you compile, no, just cross check with the business analytical procedure you apply. Report any incomplete, any inaccurate, any unsatisfactory information to management and request for correction. If at all you identify something incomplete, report any incomplete, inaccurate, unsatisfactory. Suppose if at all you found something incomplete, you found something inaccurate, you found something unsatisfactory, report it to the management. Withdraw if management fails to provide necessary information. And you know what? In the following 3 cases, you must recommend amendments. What are they? Financial information, no. The statements which you prepared, no, that does not contain applicable financial reporting framework reference. Tell them to amend it. Amendments are needed to prevent MMS. Indirectly, what does it mean? If at all you are aware of any material misstatement in the compiled information, tell the management to propose. Or compiled information is misleading. See, you don't have to get evidence on whether it is right or not. But if you know something is wrong, tell the management to amend it. So they may test you as an MCQ. An auditor who has found a mistake in the financial information compiled by him, there is a material misstatement he found. He communicated to the management. Management replied that since you are not giving assurance, it is not your duty. Wrong. Auditor has to propose. Suppose no, management refusing to amend. It's a very big mistake, is there? But they're not. They're refusing. If withdrawal is not possible, see whether you have to report to any legal authority. Generally withdraw. If withdrawal is not possible, you just withdraw if management refuses to amendment. If withdrawal is not possible, see whether you can communicate to any legal and professional bodies, regulatory authorities. And finally, get an acknowledgement from management that they take responsibility for final version. They will not use your name because you are not responsible party for the financials. You only assisted them. Ultimately, for the compiled information, who is ultimately responsible? Management only. They only have to approve the financials. You only assisted them. Yeah, you are not responsible party for preparation of financial statements. And communicate with management any important significant matters that arise during the engagement. Compilation, performing compilation, a 5 marks question might come. Any of this can be tested. And finally, next, ethical requirements. Obviously all the irrelevant ethical requirements is compulsory, but independence, since it's a non-assurance, independence requirement may not be compulsory. However, law, regulation, terms of engagement may impose independence requirement. Further, can you how to accept this work and then continue this work? You can agree on terms with the management and engaging party. If at all management is not the engaging party, and you must know intended use, where this information is going to be used, to whom this information is going to be distributed, what are the restrictions on me while compiling this information. You must know all this. What is the purpose of the information, what framework, also identify what framework they are following, applicable financial reporting framework. Also, what is the objective and scope of engagement, what you need to do, get an acknowledgement. What are your responsibilities, what are management is responsible for information, yes or no, to prepare financials as per acceptable. They are responsible for maintaining internal controls. They are responsible for accuracy and completeness of records. They are responsible for judgments that are required. They may ask you 4 marks question. What are management responsibilities in a compilation engagement? A 3 marks or 4 marks question. You just have to write these points. And finally, what is the expected form of report? These are all contents of engagement letter. These are all nothing but what? Contents of engagement letter. And finally, all these terms, you must record it in an engagement letter which is prior to starting the work. That's it. Major standard is over, almost over. So scope of the standard, remember, management retains full responsibility for financial information, including in applying judgment, selecting accounting policies. They are ultimately responsible. You cannot blame. See, just because you assisted in preparation, tomorrow if something is wrong, they can't blame you. Management is only ultimately and solely responsible for the compiled information. And remember, different financial reportings may be used. Yes or no, for compiling. So that's why you need to understand why this financial information is used, all that. And that's it. In some cases, no, management would have already prepared a draft financials where you just have to set right it properly. That's it. So then what is the objective? The practitioner, you and me, we are practitioners, have to apply accounting and financial reporting expertise to assist management in preparing and presenting financial information as per applicable framework. The practitioner's report must be issued in accordance with SRS. That's it. Over. Compilation engagement, hardly related services is over within half an hour. And now I just want to talk some important issue. I just want to talk about an important issue. Many are feeling anxiety. Many are feeling with they're having the problem of stress, stress and anxiety. So like, what is this stress and anxiety is all about? I know we are in the last month of the exam. Definitely some of you might be feel very stressful and anxiety. Okay, there is a difference between pressure. Right now I am in huge pressure, work pressure. Morning I'm having almost 5 hours of class, fast track CA final batch. Okay, CA final batch, Google Drive, on all that is there. Okay, evening again I'm doing marathon like this in live. And of course maybe tomorrow you're watching a merged version of this, but I'm just telling, almost 7 hours. This is a work pressure. In the next 10 days what I have, I'm already in the April 1st week. In the next 15 days I have to deliver close to 120 hours of content, close to, in the next 15-20 days. That's the content which I have to deliver. Imagine the kind of pressure that I have. But I'm not stressful about this. I'm not having anxiety on this. The only reason I am working on it without wasting my time, without thinking about when this will happen, when that will happen. Ayo, I'm not wasting. I am utilizing whenever time is there, whenever energy is there. I am not worrying. I am only finishing my works. You feel stressful only when you are postponing the things or accumulating your pending work. Anxiety is also only because of the stress. The anxiety, the stress, all that comes by not performing your duties. If you're daily, if you're studying daily correctly on time, no, you don't feel stressful. You will not feel stressful at all. Maybe you may have voluminous syllabus. For example, you're a CA final student or CA inter student. So you're planning for May 25 exams, for example. Exams are hardly 1 month away. Just 1 month also not left, for example. Okay, you are feeling extremely stressful, and you're only thinking about how will I write exam, should I skip this attempt, should I go for next attempt. No, first, time is there. You have 250 hours of time is there. Even now I'm doing this on April 3rd 2025, this video right now. Okay, you still have 250 hours of time, 250 hours of time in your hand. 250 hours, it's not something small. You feel stressful because you're only thinking and not working. What is most important in order to come out of stress? Forget about the result, whether you will successful or unsuccessful. Forget about the result. Why are you thinking about result? May 2nd, May 3rd my exam starts. Or if at all you're planning for group 2, May 7th or 8th your exam starts. How should I beat this? Within this time, how should I beat this? Forget whether result will be favorable or not. Fight until you win. Fight with your 100% energy. Fight with your 100% efficiency. Try to hit the target. Your only target is try to hit. Often I throw challenges with my colleagues, with my all of them. Some of them will obviously beat my colleagues or beat my friends. Some of them will doubt me. Will it happen? Will it happen? I boldly them. Yes, it will happen. I will make it. They don't trust. Some of them trust. Some of them don't trust. Some of them think Harsha is overconfident. Let it be. I am working. I know it will certainly happen. At least, if not 100 out of 100, at least I can achieve 90. For that I'm working. Challenge yourself. Throw challenges to yourself. One of your friend is coming and saying you, 25 days only, nothing can be done. It's okay. Accept the challenge. Challenge him. I will show and prove it to you. I will study the hardest and show you within this 1 month. I will try my level best and clear the attempt. Show him. Throw a challenge. Accept the challenge. Your mind works different if you accept a challenge. Believe me, guys, you have really good amount of time. The only thing is you just have to study. Stop worrying, start working. Stress is a byproduct of worry. Worry is a byproduct of not working. Okay, the more you think about, ayo, though so much pending syllabus is there, whether I will cover it or not, whether I will qualify this exam or not, all your problems, forget about that, man. Why are you thinking all that? Just start studying immediately. Forget about the result, forget about the syllabus pending. Straight away, daily, let me be like a super rock solid. 12 hours you study. You know, make yourself, you know what, I'm taking almost in a day 6 to 7 hours, that to a fast track batch and almost a marathon. Okay, which is equal to 25 to 30 hours of corporate job. 25 to 30 hours of corporate job. That much energy is required for 7 hours of class. That to a subject like auditing where I have to continuously talk. Imagine the energy. That too, you know how energetic I talk. So stop excuses. It is you who is claiming excuses. You don't have any right to claim excuses. All that you really did so much. You really did so much. Okay, I don't know whether you did in the past so much or not, but if at all you already been halfway through this 1 month, become like a monk, work like a monk. Next 24 days, challenge, you have to clear the exam. Okay, the only people who feel always stressful is the one who only think, they don't act. Only these people are highly stressful. Those who act more and think less, they never get stressed. Right now I'm not stressful, but I'm having lots of work pressure that I can handle. It's okay, I can handle. I have work pressure, so much work pressure is there, so much work is there. I'm pressurized, actually, technically speaking, but I'm not stressful at all. I'm not having guilt, I'm not having, you know, worry. I only think about, oh, I should complete work faster, I should take a break. That's what I think. I don't have a guilt. You know, if you plan something tomorrow, a schedule, you didn't work on it, guilt will start. Your guilt is accumulated a lot today. You're feeling so much stressful because your guilt is so much in your mind. You know, the only way that you can come out of guilt is start working. Start working immediately. You will come out of guilt very quickly. That's it. Okay, all the very best. Go well, do well, go ahead.